And then we have some other topics. I had a couple of people ask me about selected topics, and so what I did is I've got those toward the end of the presentation, and then we'll jump into the review of the LeBlanc return. And once we get done with the LeBlanc return, then we'll jump into, by popular demand, the Frank and Elizabeth Harris return. And so again, we'll review those two returns toward the end of the presentation. All right, so let's go to our next slide. All right, so what we'll do is we'll take a break about every 50 minutes, give you a chance to recharge your coffee and things like that. And let's go to our next slide. And so for the St. Killian's VITA leadership team, I know we have Mel on the call. I'm not sure about the other folks, but I'm sure by now most of you know the leadership team. You've got Fred, you've got Steve, you got Evelyn, you've got Mel, and you've got Art. And then John, I think, is part of that too. John is the SME. He's an enrolled agent, and I understand from John's email recently, he's really smart. Is that right, John? He is. No, I've talked to John. I believe his last name is pronounced Nagy, and he's a pretty sharp guy. Okay, so that's me, Jerry Muir, and let's go to the next slide. And I'm sure most of you by now have played with the TaxSlayer Pro program in the practice lab. I checked yesterday, and the state returns had not yet been loaded. And so if you want to get practice with the California return, then what you've got to do, you've got two options. One, you can wait until California is loaded to the 2020 tax year, or you can toggle back to the 2019 tax year, and you can practice with 2019, where the California state return will appear. And then also, if you've not used the tutorials or some of the practice returns in the practice lab, they are available on that landing page. And I've gone through some of the tutorials, and I think some of them are good. And as I mentioned previously, the lady who does them, I think she's from TaxSlayer. This tax year, or the last time she posted it, she slowed down her rate of delivery, and she's understandable now. A couple of years ago, she was a rapid fire speaker and was very difficult to keep up with her. So I think the tutorials will have some benefits, especially if you are a new or a newer preparer. All right, let's jump into it. So we're going to go to the slide that says other taxes at the very top of the slide, other taxes. All right, so let's have a discussion about other taxes. If in the VITA program, we do assist a lot of individuals who are self-employed. I have seen that at just about every VITA site that I've worked at in Orange County and overseas. And typically when you have someone who's self-employed, they will typically generate net income. And when they generate net income, if it's $400 or more, then what's going to happen is the software program will automatically calculate what is called the SECA tax. And SECA is the Self-Employment Contributions Act. And it's kind of like FICA, which is the Social Security Act for W-2 wage earners. SECA is the act for self-employed individuals. And typically when you're working with software, that's not an issue. It's going to be automatically calculated. I have had taxpayers who prepare their returns by hand, and they completely forget about Social Security tax. And then what happens is they underreport their tax. But again, that's not an issue using software. And then, and I'm not sure, I think, Mel, you'd have to correct me if I'm wrong. I don't know if we do the qualified joint venture on the Schedule C. So the example would be you've got a husband and a wife, or you have a married couple, and they're engaged in some type of self-employment together. And then what happens is once that election is made, then two Schedule Cs will be generated along with two Schedule SEs. If you do that, great. What that means is both spouses, if they're obviously they're going to have net income, they're going to be paying into self-employment. If you don't do that, then okay, then you don't do that. But I think some sites have done that in the past.
I don't think we do that.
Anybody out there in Zoom land regarding qualified joint ventures?
Yeah, Jarek, just a quick question. would the system automatically split the net income and figure out the SICA for each individual?
The system will do that, and you have to indicate in the software, you've got to click where it says qualified joint venture. And then, as I always mention, I would highly recommend before you do that, talk to your site coordinator, and that way you're adhering to the wishes of the site coordinator, and you're staying within scope.
Thank you.
Okay. All right. And then notary income, I've seen that from time to time. A lot of notaries, they work part-time. And I think in California, last time I checked, I think they get either $10 or $20 per signature. And what that means is they have to report that income, and that income is not subject to self-employment tax. And so when you get into the software, you'll indicate that it's notary income, and the software will not calculate self-employment tax. And a lot of people do that as a side hustle, being a notary. And then also, we talked about this 2 or 3 weeks ago. We talked about the tax deferral under the CARES Act for self-employment tax. And I've looked around, and there's literature, i.e. instructions to the schedule Form 1040, the Form 1040. And as far as the tabs that you click in the software, I have not found those yet. And so maybe when the software comes out in January, there'll be instructions in the software you can click. But the bottom line is you're going to calculate the tax. And if the taxpayer wants to defer that tax, and that deferral can be to the end of 2021 and the end of 2022, they can do that. They're still going to pay their income tax, but they're going to defer their self-employment tax. And there's a discussion, again, in the instructions to the Form 1040 for that. Anybody have any information regarding tax deferral under the CARES Act they want to share? Okay, moving on. Next is our discussion about tips and unreported income. We all know what tips are. Tips, typically you're going to see people at the VITA site who are waiters, waitresses, they might be valets, they might be engaged in some type of service industry where they're receiving tip income. And if they do not report that tip income to their employer, which means it's going to be run through W-2 wages, then it's not going to be subject to income tax, and it's not going to be subject to FICA. And what you want to do is you want to conduct that detailed interview to determine if they receive tips and whether or not they have reported those tips to the employer, and whether or not they're, again, paying that FICA tax and income tax on tips. This is a big issue. I've seen it a lot at the sites that I've worked at, but all you have to do is conduct that interview. And so let's talk about it a little bit. We're going to show you, after we jump into the return in the software, we're going to show you where you make that entry on the W-2 for unreported tips. And then what happens is that will be added to line 1 of the Form 1040, i.e. total W-2 income. And then there's also going to be a form that'll be generated, and that's the Form 4137. And you can see the title. It says Social Security and Medicare tax and unreported tip income. And so what will happen is that form will generate, and on that particular form, it'll show you the Medicare tax and the Social Security tax, i.e. the FICA tax. And that's how that is handled. And so let's talk a little bit, because I've seen this a lot, not only when I was an IRS revenue agent and tax auditor. I see it a lot at VITA sites where I talk to people, and I kind of scratch my head and I'm thinking, how do you live in Orange County, California on whatever minimum wage is, 13, 12 bucks an hour, and they've got 4 kids and they're not receiving any government benefits and they have no money in the bank? And the response that I typically get, they tell me, Jerry, it's not easy. And then I look at the individual and I said, well, it's actually mathematically impossible. So let's give you a quick example, and then we'll have a discussion about someone coming to your VITA site. And in the example that I show, they have no money in the bank or very little money in the bank. They have living expenses, which would be rent, food, insurance, the whole ball of wax of $40,000. They have income of $25,000, and there is no source of non-taxable income. Non-taxable income could be, for example, they borrow money, they have an inheritance, they receive a gift. And in that particular example on the screen, there's no non-taxable income. And so the delta is $15,000. And so if I was working with the taxpayer and they presented this financial situation to me, I would ask a whole bunch of questions and I'd say, well, I still have this delta of 15,000. So explain to me how you're able to pay your bills and you're short 15,000. There has to be some type of explanation. And again, they usually say it's not easy. And I tell them, well, it's not possible. And so I'm a site coordinator, and then sometimes I go to other sites and I'm a preparer, and I tell them, I'm not going to do your return because you're not reporting income. And I've seen that a lot. And what I do is I take the Care Bear approach, but I explain to them that, you know, this return may very well after it's filed be picked up for examination by the IRS. And the last thing you want is to have $15,000 of unreported income, because what happens is that auditor then would end up opening perhaps maybe one or two other returns. So worst case scenario, they open up 3 returns. That's $45,000 of unreported income. And that's what is called a significant emotional event and a significant financial event for the taxpayer. And so again, I just mention that because I've seen that a lot, and I try to educate taxpayers. I don't want to be geeky about it and talk about Internal Revenue Code sections and the Internal Revenue Manual, but unless people are exposed to this and understand that the mathematical impossibility, and that means you probably have unreported income. So I'm going to hesitate for a moment and see if anybody has a comment or if they've got a short story they want to talk about that. And I might actually pick on John if he wants to discuss that. John Nagy.
I have a question on the 4th dot down. Can you
On
hear
the
me?
what?
The 4th dot under income and FICA tax. Remember Internal Revenue Manual 4.10.4.2.8. What manual is that?
Oh, I was about ready to jump into that after we have our
okay.
discussion
Sorry.
about mathematical impossibility.
Hey, Jerry, I have a question on that.
Mm-hmm.
Is the unreported taxable income on tips, is that only an issue where we're talking about cash? I mean, if like on a MasterCard or a credit card bill at a restaurant, if you add a tip, I assume that automatically gets processed through the employer and into the W-2.
Yeah, the short answer is it's cash, because cash is, people receive cash as a tip and they stick it in their pocket, and it's obviously very hard to track that. Now, with that, then I can jump into that point. And I'm not trying to make everybody an auditor here. We're not auditors in the VITA program. We're trying to share knowledge. And that Internal Revenue Manual site, that's the site that talks about indirect income or conducting an examination for indirect income. And what that means is if you have someone who doesn't have information returns that document income, and they're self-employed or they're in some type of service industry, and per the example here, that's what an examiner would do. And even with a moderate or low income taxpayer, if that return was examined. And that's why it's important, again, not to make people auditors, but to share information at the IRS. They do conduct these examinations when an individual files a tax return and they're in a zip code and they're reporting $25,000 of income, and they've got all these other expenses. So again, what I do is I share this with people because I've seen it hundreds and hundreds of times, not just in the IRS audits, but at the VITA site. And this is something to prompt people to go ahead and estimate. Sometimes they have to estimate their income, but let's get the income that they actually earned. And I would submit to you, based on my experience in the VITA program at the IRS, when I talk to people, individuals, about their income, I would say 99.9% of the people I talk to, they can tell me within about $100 how much they make each year. So people know what they're making. But what happens is a lot of people, and especially at the VITA site, they're not reporting the income that they've earned. And that can be a bad thing for them. And that's why I mention this, and that's why I want people to avoid it.
Jerry, I have a question on this.
Sure.
The non-taxable income. So if you interview them and they say that they've received gifts or an inheritance, is there a place to report that?
Yeah, when people say, Jerry, I received gifts, I received an inheritance in the VITA program, I'm thinking, okay, great, how much is it? They cite the dollar amount and think, all right, that explains it. Now, of course, in an audit, obviously, then the auditor is going to dig and ask for substantiation. But in the VITA program, they'll provide the information, and we're good to go. All right. Any other questions about my?
I have a comment. This is Barbara Harris from Laguna Woods, ARP site, maybe VITA site, we don't know yet. What we have experienced over the years, more so than people not reporting income, is people coming in to report income for several years, so they would be eligible for Social Security. And we have turned a couple of people away because we didn't feel it was legal income.
Okay, and what type of income do they have?
Well, one of them, they would say, at one time, we had a couple come in and I asked them what type of business they were in. First, they were in construction, then they were in consulting, and they were talking about claiming $25,000 to $30,000 in income with limited expenses, so that they could end up eventually of paying Social Security. So in the future, they would be able to draw from Social Security.
I see. Yeah, that's a good point. Occasionally I'll bump into people and they provide a story to me at the VITA site. I sit down, I use Care Bear language, and I tell them, you know something, that is a story that just doesn't make sense. And I'm very frank with them. I don't try to insult them, but I tell them about my background. I said, you know, the last thing you want to do is to get in front of an IRS agent, a revenue agent who's got 5 or 10 years experience, have been through IRS school, and they're a CPA, and they know the Internal Revenue Manual. That's not the place you want to be, because if you have an assessment of $10,000 or $20,000 of additional income for a couple, 2 or 3 years, you include penalties and interest. Even for rich guys like me, that's a lot of money, and it's traumatic. I've seen it hundreds and hundreds of times where people are just, they walk out the building, whether it be a VITA site because they owe money, or they walk out of the IRS building and they're in shock because they owe tens of thousands of dollars of tax, interest, and penalties. So again, I try to educate them as best I can. I know we're limited in time, but I want to make sure people do the right thing, because again, when you're 70 years old and the IRS has assessed you, with $15,000 of tax, interest, and penalties, and most of your income is Social Security benefits, and then they find out that the IRS can indeed attach, i.e. garnish, a portion of the Social Security benefits, again, it becomes a significant emotional and financial event in their life. And I just want that to be avoided. I want people to be upfront. That's a good point. That's a good point. Okay, any other comments?
I have a question, Jerry?
Yes, that looks like Cindy.
Yes, sir. If you report your tips through your employer, he's paying a portion of the FICA tax. But if you report it through your, on Form 4137, is the employee paying both portions?
No. What happens is when you report your tips and their and FICA tax is calculated on the Form 4137, you're only paying your half. You're only paying your half. And then what happens is, obviously, then a letter would show up to the employer, dear employer, from the IRS. You've got some folks who are reporting tips. You're responsible for the other half. But no, you're only paying half.
Thank you.
Sure. Okay, then we're going to move on, and hopefully we didn't scare anybody, but again, I've seen that a lot, and I think it's important. Okay, let's talk about tax and early distributions. We had a discussion about 3 weeks ago about the COVID-19 deal, i.e. under the CARES Act. So we'll talk about that, but the general rule is if you're taking a distribution under age 59 and a half, you're going to be subject to that 10% federal penalty. And then you're also going to be subject to that 2.5% state of California penalty. And so, like I've told people, and usually it's young adults. I mean, people have lived life, they're in their 40s, 50s, or 60s. They know about this, and they know it's very expensive money. But I tell people all the time, if you're going to take a distribution, I got it. Some people either want to or have to. But if you're taking a distribution from your 401k, it's very expensive money. And then a lot of people say, yeah, it's expensive money, but I'm going to do it, or I got to do it. And so what happens is they're going to pay that income tax on that distribution, and they're going to pay that 10% penalty. That's automatically calculated in the software, both for the federal and the state. And then the exceptions, and if you have your publication 4012 in front of you, if you go to page H5 and H6, that's Hotel 5, Hotel 6, it talks about many different types of exceptions, many different types. And the one that you see, or the ones that you see at the VITA site include someone who is disabled. They have to take the money out because they got a disability, or they're going to college, higher education expenses, or they're purchasing that first home. And so that's where you would go to tell the software, this is one of the exceptions. We're not going to be subjecting the taxpayer to the early distribution penalty of 10% for the federal and 2.5% for the state. And so again, I would encourage you to kind of review that, kind of get that back in your brain. And then when we're talking about the COVID situation, and Mel, I'll probably have to load this. I don't think you have this form. If you are diagnosed with COVID, or you have experienced what is called adverse financial consequences, what that means is you're going to tell the IRS that you are not subject to this 10% because you fall under the COVID or the financial consequences due to COVID. So an example in your publication 4012, the adverse financial consequences could be you've lost your job. You have been laid off. Your hours have been reduced. So there's a financial component, if you will. And so the whole intent is, the congressional intent behind that is, you've got financial adversity. You're taking a distribution to get past the COVID times, if you will. And Congress says we're not going to penalize you that 10%. And so there is a new form. And Mel, let's see if I can load it.
You want me to stop sharing my screen here?
Yeah, stop sharing. Let me see if I can load this form. This is the form that we will see this tax year. Okay, here we go. And let's see if I can bring it up. All right, and I don't see it here. So Mel, do me a favor, go to the IRS website and download form 8915-E. 8915-E. And for those of you who are listening, that is a new form. It's for the 2020 tax year, and it deals with a retirement plan distribution due to COVID. And again, you have either COVID itself or you're suffering the financial effects of COVID. And this is the form that will be generated in the software. And again, the taxpayer who takes a distribution is not going to be asserted that 10% penalty. And as far as California, I believe California will probably conform. I don't know. I'd have to look into that. And when you hear the term conformity and nonconformity, what that means is the feds do something and California says, okay, we're going to piggyback on that. So for example, and an example only, let's say you've got cancellation of debt on a credit card and the feds say it's going to be fully taxable. California says it's going to be fully taxable for California purposes. That would be an example of conformity. So again, I don't know at present. So what appears on my screen, and hopefully you can see it, is the IRS form 8915-E. And you can see at the very top, it's used for coronavirus related distribution. And so again, this is the form that's going to be generated in the software when we start doing this next year. And what will happen is the taxpayer will not pay that 10% penalty, the federal penalty, which is a good thing for the taxpayer. And I haven't talked to anybody who's taken a distribution due to COVID, but I'll bet you there's a lot of people out there who have, because again, when you run out of money, you got to do something. So any comments about this form or the COVID situation regarding the distribution?
Yeah, Jerry, I had a question. Is that 10% penalty, is it forgiven completely, or is it what do you call it?
Deferred.
I can't think of the word, postponed.
It's not asserted, so that means it's not going to happen. And so there's no assertion of the penalty. So the individual is exempt, if you will.
Thank you.
Okay. All right. Okay. Hey, thank you, Mel. I appreciate that. And if you can bring up the PowerPoint presentation. And then again, just one more point about that COVID thing. If you go to page Hotel 6 in your textbook, you're going to see that laundry list of circumstances where if someone meets one of those circumstances, they're not going to pay that 10% penalty on that COVID distribution. And again,
Sure.
being laid off, jobless, something like that.
I
Jerry,
have a
question.
Yes.
Related to this, if a taxpayer chooses not to take a required minimum distribution because of the CARES Act allowed just not to do that in 2020, is there any special forms he needs to fill out to indicate he exercised that option?
You know, I can't tell you from the top of my head if there's a form. I cannot.
Okay, because I couldn't find one.
What's that?
I have a question.
Hold on, please. So that previous participant, what we'll do is we'll look for the form, if there is a form regarding the distribution, and we're talking about required minimum distribution under the CARES Act. Is that correct?
That's correct. Thank you.
All right, we'll take a look. See, and yes, the other speaker.
Yes, I have a question regarding the repayment. If somebody takes an IRA distribution before the CARES Act, can they repay that distribution?
Let's see. So you're saying someone's taking a distribution from a qualified plan, and they have reported that distribution on their tax return. They paid income tax.
No, it's they took the distribution in 2020, and now before the end of the year, they want to repay it.
I think they have till the day they file taxes to repay it.
Yeah, what I remember, if you take a distribution and you have to be mindful of that 60-day rule. That's what I remember.
Thank you.
Okay, all right. Let's go ahead and if you would then bring up that PowerPoint presentation, and we're on the other taxes slide.
Can you see that, Jerry?
I cannot. I see the 8915E on my screen.
Okay, let me.
Hey, Jerry, quick question.
Mm-hmm.
I'm not sure, I haven't heard if the stimulus that was handed out earlier this year, is that going to be added to income and tax?
Can you repeat the first part of your question? What type of income?
The stimulus, the 1,200 that they sent out earlier in the year?
Yeah, and the short answer to that is no, that's a non-taxable event. And also those folks who receive the additional unemployment compensation, that is unemployment income or unemployment compensation. And for federal tax purposes, unemployment compensation is a fully taxable event.
Excellent. Thank you.
Sure.
Jerry, can you see it?
I can see it. I can see it. So we've talked about tax and early distributions, and let's go to the repayment of the first-time home buyer credit. That is within scope, and it does appear in your publication 4012. And I think the takeaways there is this is my experience. If someone has additional experience, let's bring them in. I rarely see that at the VITA site. I've rarely seen that. I think I've seen it maybe once or twice. But basically what it is we're talking about the new rules. The old rules going back many years ago, that was a great thing. People got the credit. They didn't have to pay it back, meaning it was a good thing. It was a credit for them. Well, under present rules, this repayment, what it is people would get a credit. Essentially, it was a loan. And then they would pay back that loan as they filed their tax return. And so the takeaway is you're going to get into the software, you're going to access that form 5405, and then it's going to be a separate form if you have a married couple. And then you're going to indicate the amount of the repayment. Has anybody seen this at the VITA site? And if so, let's talk about it.
I don't think I've seen one in St. Killian. Maybe once, I don't know.
I've seen one, but it was so long ago, I don't remember at all.
Yeah. And so, I mean, obviously that's part of the interview that we're going to conduct. And if they have that, then you're going to sit down with them. But again, the takeaway is if you've got a married couple, you're going to generate two Form 5405s. So that's an important consideration. Okay, let's go to the earned income tax credit, one of our big credits. And so earned income tax credit, This is my experience. What I do is I'll plug in the ages, I'll plug in the qualifying child, and this thing is calculated automatically. But it's really important to talk about it because you can explain this to taxpayers why they cannot receive earned income tax credit or why they're going to receive it. And so when you talk about earned income for the purposes of this credit, it's going to be typically what we're going to see: wages, tips, net earnings from self-employment. And net earnings would, if you look at a Schedule C, Schedule Cs are basically an income statement if you have training as an accountant. And so that bottom line is going to be either a net earnings or a net loss. And I would say typically in our VITA program, we're seeing net earnings. And so again, that would be a part of that earned income. Now, this is another thing, and we had a speaker earlier. If you try to manipulate your net earnings or your net profit to generate additional earned income tax credit, that's a no-no. And so an example would be where you're not reporting expenses where you do have expenses, or you're puffing up your income, you're increasing your income. Again, manipulating the Schedule C to receive additional earned income tax credit, you can't do that. You can't do that. And so the bottom line is, when someone comes in, we're going to conduct that interview, and we're going to do our very best based on what they tell us and what they show us to report the income that they receive. We have cash method or cash basis taxpayers, which means whatever they received during 2020 is going to be reported as gross receipts. And then their ordinary and necessary expenses that are reasonable and there's a business purpose, those will be the expenses. And of course, the difference will be net earnings. So again, that's an example, and that's right out of your 4012. And then earned income does not include, and we've seen this, and again, sometimes you have to explain this to taxpayers, interest and dividend, also known as portfolio income. That's not part of the earned income tax credit, i.e. earned income, Social Security benefits, and unemployment compensation. But you can see that laundry list if you go to tab I as in India. In tab I as in India, you'll see a discussion of earned income and what is not earned income for the purposes of this credit. Okay, eligibility rules for everybody, and this is right out of your publication 4012. And I will also mention this, that publication 596, if you've never looked at that, it's the earned income tax credit publication from the IRS. It does a really good job, explains examples, and that's something that I've looked at, and I've given presentations from EITC, and that's my go-to document when I want to prepare for EITC presentations. Okay, rules for everybody. We all know that you have to have a Social Security number. And in your tab I, it talks about they have to have work authorization, but they've got to have an SSN. And I don't know how hard it is to get a Social Security number because I was a little baby when my mom and dad got it for me, but you got to have one. And so that means you have to apply, you have to be eligible for a Social Security number with the Social Security Administration. And then you have to be a US citizen or a resident alien. And that means as a resident alien, you've gone through immigration. Again, I don't know how hard it is to become one, but you got to file papers. And then the immigration folks, they say you're good to go. I think they still issue what we used to call a green card. And the last time I saw one, it wasn't green. Is anybody out there in Zoom land a resident alien that can tell us a little bit about that? Or knows about that?
Jerry, this is Arnie. I became a citizen, so I don't have a green card anymore. And even back in 1970s, when I got my green card, it was not green.
Okay.
So it's still not green, but it's difficult to get one, of course. Yeah.
This is Phil Shakurli, and I'm an attorney. And yeah, they still issue those. They're still not green. They're permanent resident alien card. And the process is you have to first have a reason to be here legally and get like a visa or whatever the case may be. And then once you've been here, you go through a process to learn English and do a bunch of things. And then you take a test. And once you take that test, you can get your permanent resident status.
Okay. Okay. And again, I'm not sure how hard it is to get, but you have to have either your citizenship or your resident alien card. And that's
the hardest part about it is actually just having a way to be here legally, not so much actually going through the process.
Yeah,
Yes,
and we see, and I'll speak for my side at Garden Grove, we see a lot of undocumented individuals, and they have ITINs, which means they're not eligible for the earned income tax credit. And so we explain that to them. We also explain the rules of reporting their income as an undocumented individual if they meet the substantial presence test.
yesterday I spoke to my neighbor friend, and she married an American and she said she filed to be a citizen. It will take 3 years only. In the past, when I was here, that was a long time ago, 1973, it took 5 years to become a citizenship.
Yeah, yeah. I met a lady, she's been here illegally in the United States for 17 years, and she's trying to become a resident alien, and she keeps running into brick walls. But yeah, you see a lot of different examples. Okay, moving on. And so also another rule is your investment income or portfolio income has to be 3650 or less. And typically that's not an issue in the VITA program. The reason that's not an issue is we work with low and moderate income taxpayers, and typically they don't have a couple $100,000 in the bank. And at present interest rates, to generate investment income of 3650, more than 3650, you've got to have a boatload of cash in your bank account. So again, typically you don't see that, but you do have individuals in the VITA program because we don't prepare returns based on net worth. We prepare returns based on income. And so I have met taxpayers who've got a net worth of $500,000 or $750,000, but their income is very modest, and so they could qualify for VITA. Next is they can't have a Form 2555. We don't teach the 2555 in the basic or the advanced certification, but when you do the international module, if you do certify, then you're going to be working with the foreign earned income exclusion. And all that means is, of course, you have to qualify. You're living and working overseas, and you're being paid not by the United States government, but perhaps maybe a corporation. And then what happens is, if you meet the rules, you can exclude income on your U.S. tax return, which means you could, if you meet the qualifications, you can exclude all of your income on your U.S. tax return. Now, you still may have a filing requirement if you're living and working in the United Kingdom or in France or something like that. But again, the 2555 is for folks who are living and working overseas. And the last time I looked, I think the maximum amount is about $104,000 per person. So that means, let's say you got two people and they're both, let's say, physical therapists, and they're U.S. citizens. They're living and working in Spain, and they both make $100,000 each. So they could exclude all of that on a joint return, $200,000 on the U.S. return, and not pay any U.S. income tax. And that has nothing to do with their tax responsibility in the host country. That's for a tax professional, not for VITA folks. But again, you see that 2555 in the international module. And then the next one, you can't be a qualifying child of another person. And that's where you're going to ask questions. And this is what I do. I do know a little bit about tax, but I'm certainly not a genius. And so I have my 4012 in front of me when I talk to people. And if they have a child that's being cared for by someone else, then I'll go through my 4012 and I'll ask those questions to make sure that the taxpayer has a qualifying child and that child is not a qualifying child of another person. And I highly recommend that. If you don't do that, then you might slip up and you might make a boo-boo. So again, just use the 4012. I think that's probably the best way to do business. And that's the same thing with the filing status. Every time I'm working with the taxpayer, I have that decision tree sitting in front of me, and I go through it lockstep and I'll ask questions because I just don't want to do it from memory. And it also, this has been my experience, it gives confidence to the taxpayer we're using an IRS publication and asking those questions. Okay, next, if you have a qualifying child, you have to meet the age, residency, relationship, and joint return test. And so let's talk a little bit about this. And I'm going to ask some softball questions. If you know it, great. Use your publication 4012 if you can. So let's see here. Mel, I can't see the student list. So Mel, call on a student for us, and I'll ask them a question. You with us, Mel?
Yeah, I'm looking. Hold on. Oh, let's go with Phil.
With who?
Phil.
Phil? Okay.
Phil Sarkisian, the lawyer.
Well, if he's a lawyer, then yeah, he'll get this. Hey, Phil,
Right.
when we're talking about the earned income tax credit and that test, that age test, what do you remember about the age test?
Let me see. I'm gonna have to look in the book.
That's okay. And while he's looking at the book, the good thing about this is when you populate the software, again, you'll ask a few questions, but the software is going to do this stuff for you, which makes it maybe not easy, but a lot easier. You probably remember the olden days when you did this with a pen or a pencil and a piece of paper. This was challenging. All right, Phil, what do you see about age? How old does the child have to be?
I'm just trying to find it in the table. There it is, page I, or section I.
Right.
And we're on page I as in India 4.
Say again?
The age is no, that's for the IRA stuff.
Phil, can I give you a hint?
Yeah, can you get me to the page number?
Page India 4, step 3.
What page again?
I is in India 4.
Yeah.
There we go. Okay. So if when is the child?
Under 19,
So they have to be
under 24.
under 19 and younger than the taxpayer. This is if you're doing earned income credit with a qualifying child, and the child has to be under age 19 and younger than the taxpayer. They have to be, if not a full-time student, but if they are a full-time student, they have to be age 24 or permanently disabled and totally disabled.
Okay, there you go. So under 19, if they're not going to school, if they are going to school, under 24, and if they're permanently disabled, then any age. And then who would determine, Phil, whether or not the student is full-time? Would it be the student, would it be the parents, or would it be the educational institution?
I believe that there's a definition in here somewhere determining what full-time is, but if not, then it would be the educational institution.
That's correct. It'll be the school. And again, I would recommend as you go through your VITA experience, that publication 596, it's packed with a lot of great examples, and you will become a subject matter expert on EITC if you're familiar with the 596. Okay, and the next test is, and Mel, can you call on a student? We're going to ask about the relationship test.
I got a question for that, in that issue.
About the
child. I guess if you're part disabled, or they're not by the definition, normal definition of disabled, but they are depending on the parents, even though they are above 24 or above 19. Because
the rule there is that you think about, just like, for example, I'm disabled. I used to be around a lot of tanks and artillery when I was in the Army and the Marine Corps. And so my hearing is not what it should be. I've got broken ribs and broken hands because of my military service, but I'm still able to walk and talk and go for a walk with my wife and all of that. And so I'm disabled, but I'm not permanently and totally disabled. If I was in a situation where I couldn't care for myself, I couldn't feed myself, I couldn't shower myself, I couldn't clean myself, all of that stuff, that would be the example of permanent and total disability. And again, I would encourage you to jump into publication 596 and you'll see some examples about that.
Okay, thank you.
All right, Mel, can you call on our next participant and ask them to come off mute?
Hey, Bernard, are you ready to assist? Unmute yourself if you're ready.
Bernard, are you ready for a question?
Hardgraves.
All right, good morning.
Is that Bernard?
Yes, it is.
Bernard, are you the IRS attorney?
No,
Oh, you're another Bernard. Okay. All right. So Bernard, tell us about the relationship test when we're talking about the earned income tax credit. What do you remember about that? And I'll give you a hint.
it's related to blood relationships, but I need to refresh my memory on it.
Okay. If you go to page India 4, step 2, you'll see some information there.
Yeah, step 2, it outlines is the child your son, daughter, stepchild, adopted child, and then there's a list of others or a descendant of any of them. So there's a pretty comprehensive list there on step 2.
Yeah, and so typically in the VITA site, we're going to see minor children, and then we might see, I see a lot of grandparents who are raising their grandchildren for various reasons. So that's typically what you can see. And that lineal descendant would be a granddaughter or a great granddaughter. That's what a lineal descendant is. Okay. And then we've got one other test. We have two other tests. The other test is residency. And Mel, can you ask someone to come off mute? We'll ask them the question about residency.
Hey, Ernestine, are you ready to assist? Do you have your 4012 with you? Please unmute if you're ready.
Yes, go ahead.
So Ernestine, Ernestine, I've met you before. You're a CPA, right?
No.
Oh, I'm striking out here. Okay, so tell us about the residency test regarding EITC. And I'll give you a hint, page India 4, step 5.
Oh, okay. It says, did the child live with you in the United States for more than half of the tax year, 184 days for 2020?
Okay.
Or if you're active duty military personnel stationed outside of the United States.
Very good. And then for active duty, we don't see that very often. There is a military module, and if you choose to certify on that, of course, talk to your site coordinator. And if you do have someone who's active duty, and let's say you've got mom and dad are living in Japan, and dad's in the military, the kids are over there, they're considered for tax purposes to be living in the United States. And that's a situation where they meet that residency rule. Okay, I'll do the last one, the joint return test. What that means is you're a young adult and you're married typically to another young adult, and you're filing a joint return even though you're claimed by mom or dad, and that joint return is filed only to receive a refund, then you're going to meet what is called the joint return test. Okay, let's get through the rest of the slide before we take our first break. If you don't have a qualifying child, you do have low-income taxpayers between the ages of 25 and 65 that can get the earned income tax credit. But again, you're talking about low-income individuals. And we're going to talk about how that computer will look at earned income and that AGI to consider whether or not they're eligible for EITC. And then I'm going to tell you a quick war story. You probably don't see this much anymore because I did this return many years ago and I did it by hand. I interviewed my mother-in-law, and I assumed that she was over 65. I prepared her return. I gave her the return. She mailed it in. And then the IRS sent her a letter, said, dear taxpayer, you were under 65 and you were eligible for EITC. So she came to me, she showed me the document. She goes, Jerry, what's this about? I said, that's easy. I made a mistake and you're going to get a bigger refund. But we don't have that in the days of software because you're going to plug in the age of the individual. But you do have, again, those I don't know if someone under 65 is considered a senior citizen, but I guess they're close. So again, they're eligible if they have that income limitation that we talked about. And then if you go to your publication 4012 on page I2, and again, this is all done automatically with the computer, but when people ask you questions, it's kind of nice to know why the computer does it, because it's obviously programmed. But what happens is when you plug in all this information, then the computer is going to look at earned income that the taxpayer has and AGI. And what happens is if you're under a certain dollar threshold, then you're eligible for the earned income tax credit. So on page India 2, I'll just read a quick excerpt. It says your earned income and AGI must be less than 56,844 if you're a married filing joint and you have 3 or more qualifying children. So you can see that individuals who file a joint return and they're making over $50,000, they still can be eligible for EITC. And what I like to describe EITC as, think of your old high school days, and remember when you took math and you looked at the old bell curve. And what happens is, if you're making a little bit of earned income and you have a little bit of AGI, you're going to get a little bit of EITC. And you go to the top of that bell curve, and you're gonna max out on EITC, and then the bell curve on the right-hand side goes down, and you're back to a little bit of EITC, because now your earned income and AGI is starting to reach that limitation. But again, it's nice to explain to people. You don't have to explain it, but if they ask, it's nice to go to that page and say, this is why your EITC is limited, because you're making too little or too much of earned income and your AGI limitation. Okay, and then again, one more plug for the publication 596. I would encourage you to review it, and I think you're going to be a lot better prepared when people ask you questions about the earned income tax credit.
Jerry, I just had one comment. It's
Sure.
the last thing in section I in the book that you didn't go over, but we did have a taxpayer last year at St. Killian's who had this problem that if you made a mistake on an earlier tax year and you're get in trouble on earned income tax credit, the IRS is going to prevent you from claiming that for the next 2 years. So we did have a lady who tried to claim her income tax credit when her husband, they were divorced, and he had the earnings and she didn't make enough to qualify. So she was disallowed for 2 years.
Yeah, when you make mathematical mistakes, the IRS can disallow it for 2 years. If you engage in fraud, then the IRS can prevent you from getting EITC for 10 years. So if people are playing games or doing things they should not be doing, these punishments, I think the 10-year punishment is pretty draconian, but Congress put it in place, and they don't want to hand this money out to people who are not eligible. Yeah, good point. And you found that on what page?
I found it on, I'm using last year's book, but it's on India 6.
India 6. Let's see if it's still in our book on page India 6. Yes.
Yeah, it's still on there on the 2020.
Yeah. The 2-year rule and the 10-year rule. I've seen that a few times, and I've explained to one person who couldn't get it for 10 years, and they go, well, I cleaned my act up. I said, yeah, you did, but you know something, you still got penalized by the IRS. And then what happens is there's an indicator in what is called the individual master file, the IMF, and then that will be explained to the auditor would explain that to the taxpayer, telling them that they're not eligible. Okay, all right, folks, and I think we've gotten past this first part. It's 9:58. Let's come back at 10:10, and we'll jump into our next section, 10:10. And when you're talking about a refund in the VITA program, that's what a lot of people are expecting, because again, they're low and moderate income taxpayers, and a lot of time they've paid in to the program. Excuse me, they paid. Let me restate that they got tax withheld as a W-2 wage earner. But when you look at the software, there's a Form 8888, and the Form 88 is an allocation of a refund. So what that means is a lot of times people want their refund to go to one bank account, either a checking or a savings. But under the program, if you want, you can allocate to various accounts. And I guess the benefit to that is, well, first of all, it's a personal choice. Some people want monies to go to more than one account, or some people may have a savings account and they'll take their refund and they'll have a little bit go to their checking account to meet living expenses, and they'll have money going to their savings account build up a savings account to build up their net worth. In some programs, and I don't think St. Killian's does this, but in some programs, when monies go to a bank account, nonprofits will match some of that for some of their taxpayers, or there may be some type of contest. And again, I don't think St. Killian does that, but that's important again, because most people, if they're low and moderate income, it's great if they can build their net worth, and that means they have money for school for their kids. Maybe they have money to open up a business, or they decide to go ahead and buy a new car or buy a new house. But again, you can do that. And the last time I looked, you can drop money into a total of 3 separate accounts. And then you can also purchase savings bonds. I know savings bonds used to be real popular when I started working many years ago. I don't know if they're popular anymore, but if you buy a savings bond, you're not getting a great rate of return, but what you're doing is you're investing in your own country. And then of course, that does pay interest. And then also when you buy a savings bond, a lot of people then think about redeeming those bonds. Well, when you redeem a bond, you can claim the interest 2 ways. You can claim the interest when you cash out that bond, or you can claim interest as you earn it. And that's something you can refer to in the publication 17 or the publication 525. But again, for the purchase of savings bond, I know it's time consuming, but again, if you have someone who's there and they want to buy a savings bond, that's a great way to get them started. And the last time I looked, savings bonds are sent to the individual for safekeeping. And if those bonds are destroyed, then because they're obviously numbered, there's a way to track those bonds to actually get a reissuance of a bond that's been destroyed.
Jerry,
and I'm going to stop here and ask: has anybody used the form 8888 before?
Yes.
Oh, who was that?
Martinez.
Martinez, is that a first or last name?
It's my last name.
Oh, okay. So, so how many times have you used the 8888 for your taxpayers?
On our site, I can't cite exactly. I know I've done it personally when I'm doing a taxpayer, maybe 2 or 3 times in the tax season.
Mm-hmm. Okay. Yeah, and I'm not trying to be a personal finance guy, but I think it's really important for people to have a savings account. And I understand the whole concept that it's a low interest rate. You know, they probably want to take their money and move it somewhere else where they can generate additional interest or maybe capital gains. But it's important to have a savings account because, as we all know, when you run into a tough situation and the only thing you have is to take cash advances on your credit card, that's probably not the best thing to do. But if you have like my wife and I, we have a savings account. We've built it up over many, many years. And that just gives us the ability to handle those emergencies that pop up. And it also gives us peace of mind. You know, and I got it for a low income individual. Maybe they only got $2,000 or $5,000 in their bank account, but it will give them peace of mind and it will prepare them for those things that pop up. Car engine doesn't work, plumbing goes out, you know, something like that. Any other questions about refunds? Okay, and then another thing that taxpayers can do if they do have a refund, instead of receiving that money dropped into their bank account or a hard copy check, they can say, you know something, I'm going to apply that refund to my 2021 tax year. And there's a check mark that you can indicate that. And then what happens is if you indicate that and the return is filed, you can't change it later, which means if you file an amended return and say, hey, IRS, I want my refund, the IRS will write you back and say, sorry, it's too late. You've already applied it to 2021, which means it's essentially money in the bank. When you file your 2021 return, that refund will be applied to whatever you owe. And I've done that personally a couple times where I know that I'm going to be having a tax burden in the subsequent year. Okay, next, amount owed. You do see this at the VITA site, and especially with self-employed individuals who don't make those estimated tax payments. And so when we're talking about the amount owed, we've already discussed earlier that you can defer if you're a Schedule C filer, which means you're also filing a self-employment schedule, you can defer your self-employment tax for those 2 years to 2021 and 2022. And I've looked in the tax slayer program that we have in the practice lab, and I don't see any place where you can go ahead and indicate that. But I did see in the instructions to the Form 1040, there is a deferral worksheet. So you might want to look at that. It's on page 101, and you can use that then again to calculate that deferral for those 2 years that are mentioned on the screen. And I think, and I think what I'm going to do, I can speak for myself. If someone asks me, "Hey Jerry, what should I do?" I will tell them, you know, you can defer taxes if you want, and sometimes it might be a great idea. But I'm going to tell them if by all means, if you can pay the tax now, you know, you might want to do that, because if you're looking a year down the road, well, maybe your situation's not going to be better. Maybe it's going to be worse, and now you're stuck with a obligation without means to pay it, or you may have to borrow money to pay it. So I'm generally going to recommend to people, if they ask me, "Hey, you know something, just pay what you owe right now." I think that's just a good rule of thumb. And in my private practice, if any of my clients ask me, I'm going to tell them straight away, pay it now. I got the whole idea about the time value of money, but pay it now, because I've seen too many examples of people a year from now where they don't have the ability to service debt or pay an obligation, and it becomes a significant emotional event.
Is this just a deferral of the self-employment tax, or is this a deferral of other taxes?
My understanding, it's a deferral of the self-employment tax.
Is this deferral free of any fees or interest?
I don't believe there's any fees associated with it. And as far as interest, I don't know. In fact, I'm going to make a note here. I'll see if there's any discussion and any tax information about interest on SE tax.
Thank you.
Okay, next, the estimated tax penalty. I don't know what St. Killian does, and Mel, you're going to have to help me out. In the VITA program, I don't think we calculate the estimated tax penalty. That's my understanding. I think that's out of scope.
I think so. I never done it.
And so people ask about it. They go, "Hey, I owe all this money. What should I do?" Well, I usually tell them you should pay it as soon as you can to the best of your ability. And you should understand that if you don't meet that 90% rule, that's the general rule. There are exceptions, which means during the year, we have a pay-as-you-go system. So whatever your obligation is, your tax obligation, you should pay 90% during the year. And if you do, then you're not going to be subject to that penalty. But again, there are certain exceptions, and you can get into the IRS material about that. But I tell people about the 90% rule, especially self-employed individuals, so they keep making those quarterly payments that they should make, not only to the federal government, but also to the state government. Again, the mantra that I use is you don't want to be facing a very large tax obligation, and you don't have the ability to pay that obligation, which means now you've got, obviously you're going to have some type of lien against you. And then, God forbid, you don't want a levy. And a levy means a taking, which means the IRS, of course, the Franchise Tax Board, they will find a way to take money from you. And you don't want that. You want to avoid that. And so that means make those payments, the quarterly payments, meet that 90% rule. And then again, anytime you're faced with the tax obligation, either pay the obligation, or you can go on installment. You can go on an installment agreement and make sure you meet that obligation. I see that a lot. In fact, I see that way too many times. And so I spend a lot of time with my clients in my private practice, and also the VITA folks that I bump into, and I explain, this is how you can do it. It's not easy, but you want to not only get current, and you want to stay current, meeting that 90% rule. And then what happens is people get into the habit, if you will, of making quarterly tax payments. And it's very painful, because if you're self-employed out there, I got it. I'm self-employed too. And it's really tough to write that big check to the federal government, say, gee whiz, I got all this money going out and I'm not making a lot. Well, you got to make the payment. That's your obligation. And if you don't, you got that penalty that you're going to get stuck with. But again, it is out of scope. I understand that. Okay, any questions before we move on to concluding the interview?
This is Joanne. It's not a question, but when some people are being helped by us in January and February, and we tell them that we could put in TaxSlayer that they can have money taken out of their checking account as late as April 15, it makes them really happy.
Yeah, yeah. I mean, I'm probably like just about everybody. I don't think I've met anybody who's happy about paying tax. But the way I look at it is, it's an obligation as a citizen, and the last thing you want to do, you want to get into a situation where you either can't pay or won't pay your tax. Again, the consequences are just unpleasant. You probably have war stories in your life, and you probably know a crazy uncle who doesn't pay tax. I've just met too many people who don't pay their tax or won't pay their tax, and it becomes very difficult for them, and it consumes their lives in some situations. And I just hey, if you make the money, just write the check. Don't go buy a new car or a new motorcycle. Pay your obligation and move on. Okay, Mel, if you can go to the next page, it says concluding the interview. All right, so this is something that is important. We all conduct interviews. We all do it maybe a little bit differently, but that go-to document is the form 13614C. And I do understand that there are other interview forms out there, and the IRS says, hey, that's fine, but you do want to use for your standard document or your standard lead sheet that form 13614C. It does come in different languages. I think at St. Killian's, the last time I looked, I think you had Spanish and English, if I remember correctly. Is that right, Mel?
Yeah, that's it.
Yeah. At my site in Garden Grove, we've got Spanish, we've got English, and then we have Vietnamese. But again, it comes, I think, in about 10 different languages. And so, and you can find those on the IRS website. Also, if you want those different languages, talk to your site coordinator. And what happens is your site coordinator will then order those different languages through the IRS. And our contact in Southern California is an employee by the name of Annette Barcelo. And you're able to, again, get those from Annette. Okay, information returns. We talked about this a number of times. When you hear the term information returns, it's a document that it's an IRS document. It could be a 1099 MISC, a W-2. It could be the family of 1099s. Information returns typically have obviously information that you're going to use for tax preparation, and sometimes they're incorrect. I think it's important to ask people about the information returns they receive, and that way you have a full understanding of their income situation. And let's see, Mel, can you bring someone off mute? I'm going to ask them a softball question.
They can unmute themselves, but on their own, so we're good. So just call anyone.
Sure.
So
this is the easiest question of the day.
Oh, really? Okay. And let's get the smartest. Adela, are you online?
To Mel.
Is that Adela?
I feel like I've been set up.
Is that Adela?
Yes.
Yeah.
Okay, so here's the question. When you hear the term information returns, how many information returns are there? How many does the IRS publish each year? How many different types are there?
Oh, I don't know how many. There's W-2s, a bunch of 1099s, Rs and miscellaneous, and I don't know how many.
So you're pretty close, Adela. The answer is a whole bunch. And then what happens is, and I see this all the time, I see this at the VITA site, I see them in my practice, people come up and they say, I got this. And I look at it and said, I've never seen this before. They go, hey, you're a tax guy. I'm thinking, yeah, okay, so I'm a tax guy, but I still haven't seen this. You're going to see information returns that are wild and wacky, and sometimes they're going to be in scope. So again, just review it. You can look at the instructions with a particular document. And again, I work for the IRS. I used to be an inspector general in the Army. I am trained to ask questions. And in my practice, sometimes my clients say, Jerry, you ask too many questions, and think I love asking questions, because if people share information with you, you have a better understanding of the tax situation. So again, you're going to see that. Okay, if we can go back to that previous slide, Mel, and we're going to talk about another item. So you've heard the term oral testimony, and we have one gentleman who's an attorney. And can we bring him off mute? I want to ask him a softball question.
Hey, Phil, are you online?
Did he go away?
Phil or Bill?
Phil Sarkisian.
Yes, I'm here.
Hey, Phil, when you hear the term oral testimony, I don't know what type of attorney you are, but when you hear that term, what does that mean typically?
Oral testimony?
Yes.
Typically that means somebody is interviewing you or you're being interviewed in court and it's what you say orally. It's not something that's written it's not something that's written.
There you go. And when you're talking to people, again, if they're going to be, and I understand people have they have diminished capacity, maybe they're forgetful, they're tired. I understand that. But when people are asked questions and they provide information to you, generally it's going to help you in that interview. They're going to say, oh, gee whiz, I had a part-time job. I had this, I had that. Or sometimes you say, well, I had some income, but that doesn't matter. Well, for me, my antennae go up and say, tell me the story. Tell me about your income. Let's determine if it's taxable, non-taxable, or if it's taxable in part. And that's why it's important to ask questions. And again, I understand we have time constraints, and that's why you want to conduct that thorough interview. And yes, 13614C, that lead sheet helps out a lot, triggering memories, but it's really good to ask. Again, I ask questions, and I have had situations with the clients, both VITA clients and in my private practice, where the questions that I asked, I was able to drill down on something to get a deduction for the individual, or sometimes they have to report income. But again, I think it's important to really ask those questions, sometimes an open-ended question, and then you can drill down to the particular topic. And I think it's important, both for VITA and in my practice, I don't want to embarrass my clients. I don't want to ask or act like I'm lecturing to them. So what I do is I want to have that conversation, and I tell them, look, I want to help you. And so let's get the information, let's extract that out of you as best we can. Okay.
And I'd like to add in, that a lot of times the clients don't know what information is relevant and important. And so, they may start telling you a story that you think is irrelevant, but it may lead into something that actually is relevant. So listen to what they say and keep asking them more.
I think that's really important because again, our clients, a lot of them, they don't know a lot about tax, and they're depending upon us. And so, what we're doing, we're using that care bear approach. We're being respectful, we're being polite, and we're just trying to help them out.
I'd like to add a little something, because a lot of it is oral testimony, whether you are the person doing the intake interview or the person doing the actual tax prep. It's really important to make lots of notes on that 13614C so that the next person in the chain knows exactly why you put in things that you put in.
That is really important, because that 13614C, it has space where you can make notes, and I'm guilty of it. I've made notes on the 13614C, and they were cryptic notes or they were scratchy notes that could not be read. So what I'm going to try to do, try to improve, I'm going to be legible, and I want to make sure my notes are not cryptic, because cryptic notes means you're going to look at a document and say, I don't know what the writer is trying to tell me. And so again, if you're precise and you have legible handwriting, that's probably the best way to do business.
How do we know whether the intake person should ask the question or the preparer? Which questions?
And again, it depends. Yeah, it depends on the site. I think if I remember from St. Killian's, what happens is that intake and interview guy or gal, they're going to give the lead sheet, the 13614C, and then that sheet will come back to the greeter or the interviewer, and they'll ask follow-up questions. And then what happens is, and again, this is my experience, that document then would go to the preparer would look at it, and the preparer would most likely ask some additional questions. And it really is based on the experience and expertise. At my site at Garden Grove, I usually have the most experienced volunteer who's my greeter and interviewer. So in that document, that 13614C gets the preparer asks basically very few questions because a thorough interview has been conducted.
Right.
Mel, let me throw it in your lap. What's your vision for this coming season? Are you going to have that greeter interviewer ask all of the questions, or is the preparer going to be asking most of the questions?
In my world, there's a lot of repeat on that one. Questions that will be asked by the greeter will be repeated by the preparer. So there's no set rule on what to ask. We try to filter in. We have a standard question, and then there will be a side question in between depending on the answer. So a lot of repeats.
Yeah, and of course, obviously, I think building rapport with the taxpayer is important, because if they are comfortable with you and obviously they have time to sit down and go through that, I think that's really important. I do recognize the fact that sometimes taxpayers get a little, I'll use the word annoyed, because, hey, gee whiz, that guy already asked me that question. And so if you have that coordination between your greeter / interviewer and your preparer, I think that's only going to help. But again, I can speak for my site. Our preparers ask a few questions, but again, I usually have an accountant or an enrolled agent or a member of CTEC as my greeter / interviewer, and they ask all the questions. So again, it's how you do it.
Another thing that we do is our tax preparer virtual on the side. They will tell us questions to ask on their difficulties, that they will say, hey, you guys in the front line, these are the 3 basic questions that we need to know as a virtual preparer. So we have a set of questions really that is, let's say renter's credit was suggested before. Make sure, because if you're an interviewer and you lose sight of the renter's credit, and then comes the virtual preparer, they don't know that, and that's an added step for them to find out. So all the basic enforced field or critical fields that they need to answer, we ask.
I think what happens is, and I've recognized when we start the season, whether you're an experienced preparer or not, sometimes you kind of forget and say, oh, that's right, I'm supposed to ask this question. But as you get through maybe about 10, 15 returns, you've got a way of doing business that you're comfortable with and your site coordinator is comfortable with. And if you don't ask a question, that return preparer is going to ask it, or the quality reviewer is going to ask it. Someone's going to ask the question. So again, I would recommend have that coordination between your site coordinator, your greeter / interviewer, and your preparer. I think every site's a little bit different, but I think the important thing is questions have got to be asked pertaining to the taxpayer, again, income, deductions, and credits.
This is Hal, from the local coordinator for AARP Tax Aid Mission Viejo. I also have the intake review personnel right on that 13614, the intake form. If the tax refund from the state is taxable, and also other information, so that it facilitates the tax counselor being able to do things more quickly. They don't have to think about, oh, is this taxable tax refund from California or not? So as you go through and you review the previous year's return, and you find out they didn't
itemize.
Yeah, they didn't itemize, then you know that refund's not taxable. So adding notes is a good idea to this 13614 form.
Yeah, and that's a good point. And Hal was talking about the tax benefit rule, and you can read about that in a number of IRS publications. But it boils down to, did the individual in the previous federal return, did they itemize, and did they take a tax benefit for state taxes paid? And if they did, then that refund in 2020 from the state of California is going to be a taxable event.
Hey, Jerry,
Okay.
this is Sean. It's kind of an obvious point for people who do the intake screening, but the bare minimum questions you have to ask are verifying their ID and their social security number, and then anything that the taxpayer marked don't know. You absolutely need to resolve that at the intake screening.
And that's another good point, and that's where that education comes into play, because I have met people, and these people can walk and talk, and they have jobs, and I've met one guy. He did not know the difference between the Internal Revenue Service and the Franchise Tax Board. So I didn't laugh at him. I simply explained, this is a federal agency, this is a state agency. He goes, oh, I didn't know that. And he was a younger guy, but yeah, that's all you do. You educate, and I think that's one of the beauties of the program. We do educate not only ourselves, but we also educate our taxpayers. And that makes, I think, a better taxpayer. So when they come back the next year, they're prepared, and it's not like they're eager to pay their tax, but they're ready to get involved, and if they have to pay, they pay or get that refund. Okay, let's move on to responsibilities. And I have a lot of taxpayers. We prepare the return, and I explain to them, based on what you told me and the documents that you provided me, I have prepared a return, and you're the one who's responsible for the return. I'm responsible for the preparation, again, based on what you told me. And I don't make it a big point, but I say, hey, look, this is your return, and whatever's on this return, it's you, which means in the unlikely event, and that's the word I use, in the unlikely event it becomes it's examined by the IRS, you're the guy or the gal who's going to be responsible for it. And then I always point down that, you remember on page 2 when you used to sign, of course now we sign electronically, well, it does say under penalties of perjury, which means it's their return. And that's an important concept. And perjury, I've got a definition there, that intentional act of swearing a false oath. And so if you're filing a return and your return is fraudulent, what happens is that the IRS gets a hold of it, they can examine it. It's not like you're going to jail. In fact, very few people go to jail. But what happens is the examiner then opens up other items on the return. They open up other returns. And again, you got a big fat tax bill. And I've seen that hundreds and hundreds and hundreds of times. So I want my VITA taxpayer to walk out the door with the correct return. I want them to be aware of their responsibilities. I don't scare them. I use care bearer language, and I say, hey, your return's got to be correct. And sometimes I've had people, when they're about ready to go ahead and leave, they go, Jerry, I've got some additional income I need to report. Fantastic. Sit down, ask them a few questions. Again, it's their responsibility. I don't want our taxpayers to walk out the door not meeting their obligation. So again, I throw that out because it's on the tax form. It's part of the form. And then finally, being comfortable, and I've mentioned this before, I've met with taxpayers in VITA, and I tell them, I look in their eyes and I tell them, sir, ma'am, based on what you told me and what I've seen, I don't feel comfortable preparing your return, and this is why. And then I lay it out and I say, your options are, you can talk to, well, of course, I'm the site coordinator. You can go out in town and you can find yourself a paid practitioner. You can go to another site, but this site is not going to prepare your return. Now, of course, if I'm working at a site where I'm a preparer, then I'm going to bounce it up to the site coordinator. But again, you have to feel comfortable. And plain and simple, you're going to see that. If you haven't seen it, you're probably going to see it in your VITA experience. Okay, I'll hesitate for a moment if anybody has any comments or questions.
I have a comment. My name is Natalie, and I volunteer at the Dana Point Center, AARP Center. And I thought maybe just going back to the information returns, do we want to mention the new 1099 NEC form?
Yeah, there's a new form this year, the 1099 NEC, which stands for non-employee compensation. And so you'll probably see those. And again, what I do with people when they show me a document, I'm going to ask them, hey, what is this for? What do you do to earn this money? But yeah, you're going to see that, the NEC, and of course, if they're engaged in self-employment, then of course they're going to report that on a schedule, C as in Charlie, and then pay self-employment tax. But yeah, that's a new form this year.
Thank you.
Okay. All right. Mel, can we go to our next slide? Okay, this stuff right here, if you've been a volunteer before, this is something that it's something you probably do on a regular basis. It's not a big surprise, but we'll just run through it and we'll have a discussion. When you talk about finishing the return in the software, it's going to ask for bank account information, and most people do not have an issue providing the type of account, whether it's checking or savings, and the account number and the routing number. I met a couple people and they tell me, Jerry, I don't feel comfortable. And I tell them, well, when you open up your bank account, your bank provided that information to the IRS. And if you're earning interest, then what happens is you're probably going to get a 1099 INT. So the IRS knows about it. And usually people say, okay, I got it. And I tell them, you know, generally it's going to be safer for your deposit to go to your bank account. If you've ever dealt with hard copy checks, if you file a return electronically and you ask for a hard copy check to be sent to your mailbox, it's not going to take a couple days. It's going to take multiple weeks. And then what happens is sometimes it's lost, sometimes people steal it and you got to get a check reissued. It's a real pain in the neck. And so I recommend using direct deposit, or if you owe money and you want the money to come out of your account, you know, obviously you can do that too. But it's just easier. It's easier for the taxpayer. And that way, you know, there's a lot of issues that are just not seen if you do the direct deposit or direct debit. But of course, account number, there are some, I've met actually some young adults. I teach an accounting class and we were talking, this is when we did face-to-face before we went virtual with COVID. And I mentioned a check, negotiable instruments, and I had a couple of young students that go, what's that? And I thought they were joking me, but they never have seen a check in their life. And that's okay. They simply use their iPhone to make payments. It's all electronic. But again, if you're looking for an account number, if you ask me right now, Jerry, what's your account number? My answer would be, I don't know. So I look at the bottom of my check or go to my bank statement. But again, it's found at the bottom of your check, or you can call your bank and you can get that account number. Most people are able to access their account number. That's usually not an issue. But again, you have to have an account number. And we've mentioned this before. You want to make sure that that account number is correct. You want to get eyes on, because I tell taxpayers, if the account number is incorrect that you give me and monies go to a different bank account, it's not like a stroke of a keystroke on a computer to change that. It is a difficult thing to get that money, i.e. the refund to the taxpayer. So that's why in the software, you're going to enter that account number twice. And sometimes, yeah, you got to call your bank. Routing numbers, it's a 9-digit code. And I believe they use the term American Banking Association ABA routing numbers. And routing numbers are different depending on the geographical location of your bank. And I've got the Southern California, and I'm going to conclude that that obviously includes Orange County, but that would be the routing number for financial institutions. And if you look at a check, if they have checks in the lower left-hand corner, that's where you're going to find that routing number. Same thing, if they don't know the routing number, call the bank, contact the bank. Most people have access to that. I'm going to hesitate for a moment. Does anybody have any information regarding account numbers or routing numbers they want to share?
Just that there are two different routing numbers for banks, one for wire transfers and one for this sort of thing.
Oh, good. Who is that? Who said that?
One.
Okay, yeah. Now, I don't know if we do wire transfers in the VITA program, but yeah, that's good to know. That's good to know. This number right here that's displayed starting with 1222, that's the routing number for my bank in Southern California, which means your VITA taxpayers most likely have that routing number.
I
Jerry,
want to add, Jerry, if I may, excuse me, if people don't have their, because a lot of people don't use checks anymore, I've had a lot of success with having the clients download their most current bank statement onto their phone and get it while they're, well, pre-COVID, when they were here in the office. Additionally, since a lot of people use mobile banking, this information is accessible through their bank application, because the bank will not provide your bank account number over the phone. You physically need to show your ID at a bank account, at the bank, in order for you to be able to get your actual account number.
Yeah, that's a good point. There's a lot of ways to do it, and it's been my experience at the VITA site when I ask for account and routing information, usually within about a minute that VITA taxpayer is able to provide it. But again, you need this if you want to do the direct deposit. And when people say, Jerry, I'm going to go ahead and wait for the check, I tell them, okay, it's your option. That's your election. You choose to do it. But you should know that that check is going to take multiple weeks to arrive in your mailbox.
What I do,
Yes.
This is Jana Abrams. Can I jump in? At Laguna Woods, before the taxpayer signs the 8879, I have them verify the account number and the routing number and initial it, actually, just so there's no mishap later on.
Yeah, that's a very good point, Anna. This is Mel. When I have a situation like the other lady said that the account number and routing number is in their mobile phone, I have them write it on the intake interview on their writing, and I double check that, and I do the 8879 to verify, because part of my training is we should be deadly accurate on routing number.
Actually, at Laguna Woods, we prefer to see the actual check. We don't take it from the previous return or mobile home. We actually ask for the actual check, not even the deposit slips.
Yeah, our demographics is maybe younger. They pull out their mobile phone. So it is just a way we devise that, okay, the mobile phone is very accurate, but we make them write it on their intake interview.
Okay.
And then make them understand that once this get lost in the electronic jungle, we cannot help them.
Jerry? This is Bill DeLuca. My account number is 11 numbers. Can it be any amount of numbers? I mean,
What I remember from the literature that I've read is bank account numbers in the United States go all the way up to 12 digits.
That is correct. I agree with that.
Okay, moving forward, again, I think a lot of the stuff is pretty basic, but if we have any conversation, we'll do that. Global carry forward, most people say, yeah, sign me up for it. And my understanding of global carry forward means if you go to another VITA site or another AARP site or another TCE site and you say, yeah, sign me up for global carry forward, what that means is you can go to that different site and they can import that information from the previous tax year. It simply saves time for the taxpayer and the tax preparer. And again, most people say, yeah, sign me up for it. If they say no, don't sign me up for it, okay, then that means if you go get your tax return done at another site, then all of that data has to be inputted. Here's something on the software. When you prepare the return, you're going to get it ready for review, and that means it's ready for a quality reviewer. You want to make sure you check that. And then I don't see at VITA sites where you've got preparers who are actually able to electronically file. They're not given that permission. The electronic return originator has only a couple people who are able to actually send the return in, e-file, if you will. We talked about quality review. It has been my experience you want people who typically have been in the VITA program for a couple years to be your reviewers. You can have a new guy or a new gal do it, but typically you want someone who's got a little bit of experience, and it usually works out that way. Printing a courtesy return, we all do that. I think we all do that. Now at my site, what I'll do is I may select certain pages. There's certain pages of the return that they don't need, but typically we'll hit print. We'll go through the return with the taxpayer, and then that way they've got a return. Now going through the return, would you discuss each and every line item on the tax return? I would submit to you, probably not. Would you go through each and every form of the taxpayer? Probably not, because if you had a 40-page document, that could take you 3 or 4 hours. I think your site coordinator will sit down with you and say, you probably don't want to do that. So you probably want to talk about adjusted gross income, taxable income, your tax liability, and then your refund or what you owe. I think that's probably what you want to do with your taxpayers. That's at a minimum what I do with my taxpayers. And then sometimes they'll ask me a question about the Schedule C or the Schedule A. We'll go to that document, and then we'll go through it as needed. And then, of course, you review things with the taxpayer. People do things differently. Typically, we'll do the review electronically before we hit print, so we're not wasting ink and paper. And then that signature in the 8879, sites do it differently. I know every site's supposed to get the signature of the taxpayer in the 8879. And Mel, I'm going to throw this at you. Do you also get the signature on the California e-file authorization document? Oh, you're on mute, Mel.
All the time, Jerry.
Okay, so you get both then. Okay, so there are some sites only get the federal one, but that's great. And so, of course, with that signature, that gives permission to the ERO, the electronic return originator, to electronically file that return. Okay, anything about finishing the return?
Yeah, Jerry, quick question. Can you hear me?
I can hear you.
Okay. Is there anything in particular that you focus on during the review of the taxpayer about looking at what the any obvious impacts on their next year's refund? Sometimes what I find is people think their refund is fixed year over year because it's oftentimes very similar because their personal situation is comparable year over year and the tax laws haven't changed. But I've had situations where you can see that, say, a child is going to time out of a EITC or child tax credit or something like that. Are there any 2 or 3 things you focus on that you would say to a taxpayer, hey, just recognize this is changing in your situation and it will impact your refund?
You know, I think you mentioned one is certainly children, because when children move out, they're on their own. And of course, the taxpayer is not entitled to certain credits. As far as income usually does fluctuate with individuals. I grant you it may not fluctuate 50 or 100%, but income does go up and down. And then I tell people, just based on my experience, tax law changes each and every year, sometimes a little bit and sometimes a whole bunch. And so when people say, hey, Jerry, my refund last year is $5,000, I'm thinking, okay, your refund is $5,000. Well, then this year I should get $5,000. I tell them every tax return is like a person. It's different. And there's all sorts of things that go into a tax return. So what we're going to do, we're going to determine what your refund is. And I'll explain that to taxpayers. And of course, it depends on how much time I have. But again, I have people, they think their refund is set every year at $5,000 and thinking, well, it might be, but you know something, things change. And obviously with the CARES Act, things have changed. So yeah, that's what I'll do. And of course, obviously, if they're self-employed, I tell them their self-employment most likely will fluctuate. If it's a new business, they're probably going to be making more money, i.e. they're going to be paying more self-employment tax. So yeah, I think that's important, you know, give them little kernels of information, but I don't think we're going to sit down and do full-on tax planning because we simply don't have time. But giving them the education, I think is important. And then one last thing, and I recognize the publication 17, it's a large document, but I tell people, if you read anything or refer to any document in the IRS, you should have that document available electronically so you can go in there and read selected portions of the publication 17, and that'll make you smarter as a VITA customer. Okay, let's see. Can you go to the next slide? I did have a question, a couple questions, and I'm not able to answer all questions through the email, but I had one regarding step up in basis, and I don't usually see this very often in the VITA site, but when you're talking about a step up in basis, just an awareness. On the screen, it says your step up in basis, you're going to readjust the value of appreciated assets. So it could be, for example, maybe shares. You have someone who inherits shares. And you should know when you inherit something, whether it be a bank account, whether it be a farm or a house. When you inherit something, the general rule is there's no income tax that you have to pay on it. Now, if you inherit a house and you place it in service as a rental, you're going to report the rental income. If you inherit a 401k, which is all tax deferred, then of course, obviously, then when you receive that distribution, you're going to have some type of tax consequence. But again, for step-up in basis, it's appreciated assets. You're looking at the fair market value at the time of the inheritance, and what that does is it's going to minimize, or in some cases, eliminate that beneficiary's capital gain. So let's look at the example, and it's a very narrow example, and I'm not going to discuss any other ones because it could really get complicated. So anyway, you've got a son, his name's Ricardo. He inherits stock from his father who's passed away. So Ernesto's passed away, Ricardo gets the stock, and the stock cost the father $16,000, and the fair market value at the date of death is $96,000. And so what that means is Ricardo receives a step up in basis. So the basis of that stock that he inherited is $96,000. If he sold that stock for $96,000, he would have no capital gain or no capital loss. And so that's an example of step up in basis. And again, we're not going to get into a big, long conversation. If you bump into someone who's got, they've inherited property, a lot of times you're going to have to recommend they go out and see. First of all, I'm all about attorneys. I met a lot of sharp attorneys. My brother-in-law, he's a tax attorney. And when I have questions, I ask him questions about that. So attorneys are sometimes very valuable. They save you a lot of time and money and a lot of heartache. And then also find that tax practitioner if you have someone who's inherited a farm or a house or a 401k or something like that, because there are tax consequences that you want to avoid. But again, this is a step up in basis.
Hey, this is Phil Shakurlian again. Is the step up in basis even part of VITA scope? Because you have to have some pretty good documentation to prove what the new basis is.
The answer is no, but this was by popular demand, and this is an awareness item. So when that guy or gal comes in your site and say, hey, I've had this, you can say, okay, well, this is what I know. Go out and find yourself an attorney and or a paid practitioner. Perfect. All right, next slide. Okay, the recovery rebate, and the recovery rebate is discussed in the instructions to the Form 1040 on page 57. So here's the bottom line. Eligibility. If you didn't get that economic impact payment, a lot of people got either $1,200 or $2,400. If you didn't get that, or it was less than that $1,200 or $2,400 married filing joint, then you're going to complete that worksheet. I haven't seen the worksheet in the software, but when the real software comes out, there'll be some type of tab where we'll be able to click and enter that data. Again, that economic impact. I didn't get one of those. My son did, and I think he got like $1,200. So most of you out there, or most of the VITA customers we're dealing with, they probably have received that impact payment. But if they didn't, then you'll utilize that worksheet or the worksheet in the software to calculate the amount of the credit. And then you're not eligible if you got the full $2,400 and you don't have any qualified children. So I think you're going to see this, especially with people who perhaps didn't file their 2018 or 2019 return. So you'll probably see some of this. But I think the short answer is look forward to a tab in your TaxSlayer software. All right, and can you go to the next slide, Mel? This is part of the CARES Act, charitable contributions. It's not a lot, but it's better than a kick in the head. And so what happens is you have a taxpayer who is going to take the standard deduction. They don't have the itemized deductions that are greater than the standard deduction. And then what happens is they've made contribution to some qualified charitable organization, cash contribution. What they can do, they can take an above the line deduction. So all you have to do is go to the schedule A as an alpha, open up the charitable contributions and input the amount. The limit is $300. If you put in 1,000, the computer will limit it to 300. And then what will happen is that $300 amount will be carried forward to page 1 of the Form 1040, and that's an above the line deduction. And so we're probably going to see that at the VITA site a lot for standard deduction folks. Okay, and then if you can go to the next slide. Okay, what we'll do when we come back from break, we're going to go through this LeBlanc, I pronounce that right? LeBlanc? Yeah, LeBlanc return. We are going to utilize tax year 2020, and we're going to show you the EITC, the additional taxes. We're going to talk about that premium tax credit, which is that refundable credit if you're in covered California or what is called the federal marketplace. We've got other income item we're going to discuss, which I see a lot at VITA. And then we're going to talk about where you enter the data in the software for estimated tax payments. So let's do this. Let's come back at 10, I stand corrected, 11:12, and we'll talk about this. So I'll see you in 10 minutes. Back, we are going to now discuss the Frank and Elizabeth LeBlanc return. Mel, can you see the Word document on the screen?
Yes.
Okay, great. And so this was a return I sent out 4 or 5 days ago. It has EITC. It's got some additional taxes, that premium tax credit, which is a refundable credit. I've got another income item, which we'll talk about, and estimated tax payments. And so we've got our taxpayer, Frank. This is his administrative data. And it does say that he qualifies for the renter's credit. However, the tax return that we're going to generate will only be a Form 1040 because the 540 is not yet loaded in the practice lab. And then we've got the taxpayer spouse. So her name is Elizabeth. And there's her administrative data. And then you can see here on page 2, it says Frank cannot see better than 200 in his better eyes with glasses, and he's had this condition for many years. Since he was 15, and he's got a letter from an ophthalmologist. And ophthalmologists, if I remember correctly, are medical doctors that specialize in the eyeballs. So again, he is, according to this definition, this is your tax definition of legally blind. He's got a W-2 from the t-shirt shop. He's got some federal tax withholding. He's got state disability insurance, and that's a compulsory program for a lot of taxpayers in California. Some people don't pay it. Like I was a federal employee for many years. I never paid into the state disability insurance program. When you do pay into it and then you subsequently become disabled or you're injured, you can draw from that if you qualify. And if you're an expectant mother, you pay into it, and then your doctor says, okay, you need to stay home, you need to care for yourself and the baby. That would be a situation where if you qualify, you'd receive benefits from the state of California, which would not be taxed. And let's see, here's our W-2 for Elizabeth, who's a licensed practical nurse. Same thing, she has wages, federal withholding, state tax withholding. And you might remember when you enter the data into the software, that state tax withholding is carried forward to the schedule A as an alpha. Interest income, and I think we all know this, whether you receive $1 or $1,000 in interest income, you're going to report that on your tax return. Most of the time, not all the time, but most of the time, interest income will be evidenced by an information return to 1099 INT. And then we've got some dividend income. And then we have this court settlement. And let's see, Mel, can you call on a student and ask that student to read the paragraph for the court settlement?
Hey, Marisa, can you help with that?
So court settlement, $90, VITA versus Bank of Buffalo. During your interview with the taxpayers, you determined this class action lawsuit was settled to refund interest overcharged on personal auto loans taken out in 2018. The taxpayers took out an auto loan in 2018 for their used 28 Toyota Yaris and only used the Yaris for commuting and personal travel.
Okay, and I have seen for some reason, I can't explain it, I've seen a lot of these court settlements coming to the VITA site, and typically they're class action. And as I understand class action, that means you have a judge, whether it be a state or a federal judge, he or she will certify that this group of people, whether it's 20 or 200,000, they have an action against a corporation for a particular reason, and they slug it out in court. And what happens is you have monies that are distributed per the settlement. And of course, obviously, the attorneys are going to receive their fee, but the settlement would go out to the individual. And so in this particular circumstance, this would not be a taxable item because this is a refund of interest that's paid, and the taxpayers did not take any deduction for interest paid. So this is something that would not go on a Form 1040. It would not be entered into the software program. And then I would mention this to you. If you have a court settlement, and I get this a lot, people say, hey, Jerry, I had a court settlement. I got 500. I met one guy, he got 20,000. What I always do, I always tell them, okay, well, tell me about it. And sometimes they don't have the information. And so they're able to dig down and find the actual settlement document itself, especially when you're talking about multiple thousands of dollars. And then what you do, you don't have to be an attorney. I mean, it's great to be an attorney, but you don't have to be an attorney to read a court settlement. If you know a lot about taxes or a little bit about taxes, you can figure out whether it is a taxable event, a non-taxable event, or it's taxable in part. But this example right here, this is a non-taxable event. And I would encourage you, if you do see these court settlements, ask the questions. Sometimes the taxpayers got a call and say, hey, what was this all about? Or maybe it can go to a URL on the internet, and they can find the description of the settlement. You can also look in IRS publication 525, where it talks about non-taxable and taxable sources of income. Okay, any questions from anyone regarding the court settlement?
Yes, this is Evelyn S. I couldn't figure out what to do with this, and I realized that you're saying the only reason it is not taxable is because they didn't itemize?
No, if they had taken a deduction in a previous year for interest paid.
Yeah, that would be itemizing.
Well, it would be a Schedule C item. You cannot itemize interest that you pay on a personal auto loan.
Okay, okay. So we don't actually know that.
Know what?
Whether they took it in past years or not.
Yeah, and that's why you would ask the question of the taxpayer. I always say ask those 20 questions, because again, I've seen this, and people shove a document in front of my face or put it on the table and say, hey, what's this? I'm thinking, well, you tell me, you're the one who received the document. Well, they'll say, I don't know. Well, let's call the number. Let's get a hold of the law firm. And again, sometimes you got to do a little digging with the taxpayer, but usually you can find the answer. And then this is what I do. I have situations where we simply could not find the information, and I tell the taxpayer, this is how I do business. I'm going to go ahead and declare it a fully taxable event. We'll put it on the return. That way we're safe. And if we find out later it's a non-taxable item, you can file an amended return. But again, I see this a lot.
Okay, that makes sense, because really I couldn't figure out what to do with this. And,
So yeah, no consequence, not entered into the software. Right. Okay, we have dependent one, Fiona. She is a young girl. And then we have Philip, and he is a young guy. And then we have additional information for the LeBlancs. I put down that they've always taken the standard deduction. They will always take the standard deduction. And what that means to me is if you're a standard deduction person, your state tax refund is a non-taxable event, non-taxable event. And again, when you're talking about a state tax refund being taxable, you have to itemize in the previous year. On your Schedule A, you also have to take what is called a tax benefit. And for the geeks out there, that's Internal Revenue Code section 111. Okay, moving on. The LeBlancs did receive a refund from the state of California, and that's to the tune of $375. And that would be reflected on a Form 1099-G. So we know the treatment on that. There's no tax consequence to that refund because they didn't itemize. And then we have the LeBlancs enrolled in Covered California. Covered California is one of those programs for under the Affordable Care Act. You've got the federal marketplace, and in certain states, and I don't know all the states, but I know California is one of them. Their program is called Covered California. In other states, it might be called something different. But the bottom line is what it is. It is subsidized health insurance. So that means the taxpayers subsidize the individual here, the LeBlancs. And then what happens is at the end of the year, the LeBlancs are issued a 1095-A as an alpha, and that will describe all of the subsidies that they received. And what you're going to do, you're going to use that document to actually prepare the tax return. I do have taxpayers from time to time, they'll say, Jerry, I don't have the 1095-A, and I tell them, okay, you can come back later, you can get that document. I don't know how easy it is. I don't know if you press a button and it prints out on your computer. I'm going to guess it doesn't. There's probably, you got to jump through some hoops to get it. But I tell taxpayers, in order for me to prepare a return, I'll need this 1095-A as an alpha. That's part of what we call the reconciliation. It's required. You got to have it. Got to have it. Okay, and do we have anything else? Oh yeah, then she's a self-employed tutor. And she makes a little bit of money, $4,000. She's got some supplies to the tune of $300, and she also has estimated tax payments. In this example, she has three of them, and for $100 a piece. And then we got Frank. He worked at the Green Bean Coffee Corporation at one time, and in tax year 2020, he received his 1099-Rs in Romeo, because he cashed out his 401k. And a lot of people cash out their 401k. It doesn't make them a bad person. It simply means they cashed it out, and some people will use it for certain things. Based on this description right here, he doesn't qualify for that COVID exception, which means this is a normal distribution. And this is a distribution where he is going to pay that 10% penalty because he's doing fine. He cashed out and bought a motorcycle. And then also they donated money to a qualified charitable organization. And because they do not itemize on their Schedule A, they're going to get this amount on page 1 of the Form 1040. And then we've got Elizabeth. She was either unable or unwilling to pay her credit card. So what happened is the credit card corporation, they discharged the debt on their corporate books and their corporate tax return, which means Elizabeth received a Form 1099-C as in Charlie. That's an information return when you have discharge of debt. And if you jump into your 4012, the rule is if you're not insolvent, which means you have negative net worth, and you're not in bankruptcy, that means that discharge of debt is a fully taxable event at ordinary tax rates. And I've never been to bankruptcy. I guess that's a good thing. But when you go into bankruptcy, the bankruptcy world is a whole different world. And, but again, this is shared with you. You just want to ask us questions. Were you insolvent? People say, what's that? You say, well, that means you've got more liabilities than you've got assets. And if they go, no, I was solvent. Okay, have you ever been to bankruptcy? Nope. Then that means this is going to be a fully taxable event. Okay, before we jump into the actual software, any questions regarding the Frank and Elizabeth LeBlanc scenario? Okay, then let's go ahead and jump into the software here. And Mel, can you come off mute? Because I was teaching a class a couple days ago and it was almost traumatic. I could not get my, my Zoom to show the practice lab. Can you see the practice lab?
Yeah, it's there.
Mm-hmm.
Okay, great. All right, so let's go ahead and go to our Frank and Elizabeth LeBlanc return. And let's see. And for, again, if you're ever working with the practice lab and you want to toggle back and forth, you can see up here, you hit change the tax year. And for the real software we're going to be using, if I remember correctly, I think you have the opportunity to go back 2 or 3 years. And so if your site coordinator says, yes, prepare prior year returns and you're comfortable, then by all means do so. At my site, we do prepare prior year returns. However, I only have selected personnel do it. Okay, so we're in the 2020 tax year. And let's see if we can find our friends, Frank and Elizabeth LeBlanc. And I'm going to mention this because I did have some questions, I think, from a couple folks regarding the returns that we looked at in previous sessions. What I'm going to do, and I'm not going to do it today because I must watch the Army-Navy game, but tomorrow what I'll do is I'll post the school solution to those previous returns that we looked at. And so you can look at those, and then next week I'll be more than happy to entertain questions, but I don't think we're going to be able to do it today. I think we're going to run out of time. Okay, so basic information regarding our taxpayers. And Mel, can you come off mute and can you select a student to answer a softball question?
Okay. Softball, my favorite. We'll pick somebody that's we never heard of before. Miss Montes, Saritza Montes. Can you help?
Are you able to come off mute?
Are you saying Martinez?
That will work.
Okay, it's Martinez, not Martinez.
Okay, and so here's your softball question. And what's your first name?
Catherine.
Catherine. In the VITA program, do we prepare and married filing separate returns?
No.
Okay. And when someone wants to file a joint return, is that something that is mandated or is it an election?
It's an election as far as I know.
Correct. It's an election. You choose to do it. There's no federal judge, there's no state judge, there's no administrator that can require you to file a joint return. It is an election. Okay, so the taxpayers here choose to file a joint return. We have, and I've been asked this question before. They go, Jerry, can I put my wife first? Can I put the husband first? It doesn't matter. You can put whoever you want first. In this case, we're going to put Frank. This is a joint return, which means joint and several liability, which means the general rule is they're both on the hook for the tax obligation. And so that means if Frank loses his job and ends up living in a garbage can, and Elizabeth continues to work, and if there's a tax obligation, and if Frank is unable to pay it because he has no income, then the IRS then would shift over to Elizabeth and said, Elizabeth, you filed a joint return, you have joint liability, and you also have several liability, which means we're going to camp on your doorstep to collect that tax. And so that's how it works. That's the general rule. There are exceptions to the general rule. Okay, so we've got Frank's data.
Jerry,
And
it's Paul Abrams.
Question?
If the taxpayer, the husband filed last year and this year you put the wife's name, I don't think he'll pull up last year's information.
That may or may not be the case, but I do know this. If someone says, Jerry, I'm the wife and I want to be first in the return, my answer is okay. And that's what I do. All right, so Frank is blind according to the tax definition. You can find that definition in various IRS publications to include the publication 17. And then we have Elizabeth's data here. And she is an LPN, a licensed practical nurse. And we did talk about this, the Presidential Election Campaign Fund. That simply means if your taxpayer wants that, they are directing the federal government to separate or segregate monies, taxpayer monies, and those monies then go to the fund. And then if you're a qualified candidate, then you apply to that fund for monies to run your campaign. It doesn't affect the refund, of course, of tax return. All right, and then we also know in this software, you have to provide your telephone number. And I do know in the VITA program, there are other softwares that are used. I know a guy who uses TaxWise for some reason, but I believe you still need to type in your phone number. And I've mentioned before, to my knowledge, IRS employees will not call you out of the blue and say you owe money. If that happens, you should tell them, if you're an IRS employee, then you need to go ahead and send me a letter and tell me why I owe money. But they being the IRS will send you a letter in advance. You're going to know if you owe money. I get these crap calls all the time. My sister's got them, my brother's got them, and you just tell the person you're a fraudster and hang up on them. If you're a legitimate IRS employee, you're going to send that letter. Or if you do call, I used to call people, and we're talking cold calling, but only for the purpose of informing them you're going to be examined. We're going to set up an examination time and date and location, and I'll follow up with a letter. But again, you want to be very careful. People calling you for money, that again, that's a fraudster, a bad person. Okay, basic information. We've got our dependents. We've got Fiona, who is our daughter. She's a young girl. So let's start with her information. She's born in 2015, so she's what, about 5. And then down here, we talked about, and typically in the VITA program, you're going to have a U.S. citizen or U.S. national. We talked about those nationals are resident alien, so you'll check there. And then typically in VITA, it's going to be 12 months. If it's less than 12 months, you'll simply hit that drop-down menu and indicate the number of months that the child stayed with mom and dad. Okay. And so we're done with that. And then Mel, can you have someone come off mute, and we're going to ask another softball question.
Okay. Kim, iPad, can you help?
So Kim, can you hear me?
Let's pick another one. Hey, Min, can you help?
Okay.
Oh, okay.
Can you hear me now?
Go ahead, Kim. Yes.
And Kim, is that your first or last name?
First name.
Your first name. Okay, great. Hey, Kim, what happens if you have a child? Let's say the child is 10 or 12 years old, and for some reason is working as a wage earner, maybe a child actor or something like that. Let's say this child, this minor child who lives with mom and dad, let's say they have a W-2 and their W-2 is, let's make it $25,000. Does that minor child have to file a tax return, or can we combine those wages to mom and dad's return?
I think we don't do that. We don't do child kitty tax.
Oh, no, it has nothing to do with kitty tax. That's a wage earner, a minor child that's earning wages.
I think she had to file on her own, and the child file on her own, because that's 25,000.
That's correct. If you have a filing requirement, whether you're 1 or 99 years of age, yeah, you would file your own return. You don't combine those wages with mom and dad's wages. That violates what's called the assignment of income doctrine. Okay, so this is Phil. He's a young boy. He lives with mom and dad. Okay. And now we're done with dependent children. And let's go to our income section and let's review that. Okay, here we go. All right, we got our wages. Let's go to the taxpayer, which is Frank. And you can see I've entered the data for Frank here. T-shirt shop. And we know when we enter data, we put in that zip code and it auto-populates a city and a state. There are the wages for Phil. I stand corrected, Frank. And I'm going to point something out here. If you look on the screen in the box that says unreported tips in the lower right-hand corner, what I was doing, I was playing around with this. Now, this scenario doesn't have unreported tips, but I'm going to point this out. Then I'm going to erase the 120. In this particular case, you had unreported tips of $120. So what would happen is, if I save this, then that $120 would be included on line 1 for total wages. And then, of course, you would go to the 4137 screen and you would enter data if they had unreported tips to an employer. But in this case, this individual does not have that. And that's part of that interview process. And there's a lot of people that receive tips, and you're going to receive various types of answers. And what I tell people, I say, look, if you received tips and you didn't report it to your employer, you want to report it on your tax return. And the consequences, if you don't, a trained IRS agent using the Internal Revenue Manual and those indirect income methodologies, they're going to determine pretty much what you make, and you're going to get a big tax bill. And if you don't believe me, talk to an IRS employee, and they will tell you, oh yeah, we do that all the time. I used to do it all the time as an IRS employee. So again, just report what you need to report. Okay, so in this case, we're good to go with Phil. Frank. Okay, we got that. So we're done with Frank. And then we're going to go to his spouse, which is Elizabeth. And this is pretty basic stuff. We probably have done this hundreds and hundreds of times. And Mel, can you have someone come off mute? I'm going to ask them another softball question.
Hey, Richard Radecki, can you help?
Richard?
Oh, okay.
Richard, quick question for you. When we enter data in the software regarding the California State Disability Insurance Program, in this case on the screen, box 14, that amount of $222, where will that amount be carried forward to on the return?
Will be carried forward to the deductions for taxes. Okay.
So you're saying the Schedule A is an alpha?
Schedule A, yeah.
Okay, you're correct. You're correct. And then down here, we've got the California information. And I do recognize that a California return will not be generated because it's not loaded into the software. But again, you're going to enter that data. I think we used the term years ago, you key it as you see it. That's the mantra. That's what we do. We enter data as we see it on the document. Okay, so we got the W-2. We're going to go over here to other income. We've got dividend income of $15. That's that ordinary dividends. And Mel, can you have someone come off mute?
Hey, Mike White, can you help Jerry out?
Hello?
Hey, Mike.
Yes.
Let's say you've got your 9-year-old cousin who comes up to you and says, "Hey, Uncle Mike, what's a dividend?" What are you going to tell your young cousin?
A dividend is a return on an investment on a stock.
That's basically it. You've got a corporation or a mutual fund, but a corporation, you got the board of directors, they've got retained earnings, they've got cash in the bank, they vote to pay dividends to their shareholders. And then what happens is you either get the dividend check dropped into your bank account, they send you a check, or in some cases, you direct the corporation, I got it, I'm going to get my dividend, take my dividend, and buy additional shares. That's called a dividend reinvestment plan. That's called constructive receipt of dividends. You still have to report that on your tax return because you're going to get that 1099 DIV. Okay. All right. So we're done with the interest and dividends. Let's go to retirement income. And let's open that up. And if you recall, we've had a taxpayer. This is Frank. Frank took his 401k and he cashed out. A lot of people do that. And this is 2020. He didn't have any COVID-related stuff. He bought a motorcycle because he thought it was cool. And so what happens is we're going to enter that data, that 2,500, and our distribution code is 1. Mel, can you have someone come off mute?
Hey, Scott Medley, can you help Jerry out here?
Sure.
Scott, when you have a 1099 DIV, I stand corrected, a 1099 R's and Romeo, those distribution codes, where would you find your distribution codes? Because one doesn't mean anything to me. What's the description of these codes? Where would you find?
If you have the physical paper, you turn it over, the print on the back in very, very fine print.
Yes.
Or you can also find them in publication 4012.
Bingo. Very good. Thank you. Yeah, you can find it on the back of the document, or you can find it in your publication 4012. And there are many different types of codes. I don't have them all memorized, but I do know this. I key it as I see it. Okay, so we've entered that data. And now we're going to go to our Schedule C. And this, I think, is new from last year. I know a number of years ago, these large fonts did not appear. I think that's very helpful for the taxpayer and the tax preparer. So we have a Schedule C. She's a tutor. This is Elizabeth. And because she does not have a, she's not doing business as.
The 1099R for Frank, wasn't there a page 2? Didn't it take us to page 2 so that we could check, whether it's our retirement plan?
Sure, we'll go to page 2. Let me knock out the Schedule C here first.
Okay, I'm
and
sorry.
So we do not have doing business as, so we're going to leave that data blank at the top. Her business code, I went into the business code. This is a voluminous list, and I found this particular code, 611000. Good enough for government work, educational. Boom, done. Questions about her business, we'll open that up. Typically, you're gonna have your cash method, which means that's what we do in VITA. If they're accrual, which means they're going to report their income when they earn it, they're going to report their expenses when they incur them. That's outside of the scope. They're going to have to go out in town to a paid practitioner. We don't do inventory in VITA, so you can put down not applicable. And in VITA, we only deal with people who materially participate. We talked about that earlier. Simply means they are involved in their business on a regular basis. And again, I can't remember, I'd have to check the 4012. If qualified joint venture is in scope, you would check there. My wife and I, we're both practitioners and we have a qualified joint venture. We have a tax practice. But again, you need to check with your site coordinator or the publication 4012. Okay, we've got that. Let's go into the Schedule C expenses. She only had expenses for supplies. And I think we had, here we go, $300. This is something when you're dealing with a self-employed individual, sometimes you're going to have a business expense that they'll forget about. And so if you ask them those questions, it'll elicit a response and say, that's right, I've got an additional business expense. And so you enter it there. Okay, this is a very basic Schedule C. And so we're done with our Schedule C. Let's go back by popular demand to the 1099 R's in Romeo. Okay, we've entered all that data. And I think we get to page 2 by hitting continue. Here's your distribution penalty. You're going to indicate, here we go. Up here it says, the computer has identified it as an early distribution because our taxpayer, Frank, is under 59.5. So the general rule is that 10% penalty will be asserted. And in this particular case, and I forget who asked that question, but is this the page you were looking at?
Yes, it was Arnie, yes.
Okay, Arnie, okay. And so, and again, if the person was not subject to that 10% penalty, then we would open up yet another screen. Okay, so we're done with that. Let's go to the 1099 C as in Charlie. And again, if someone receives this, that means they're either unable or unwilling to pay their debt. And if they have net worth, which means they're not insolvent prior to the discharge, or they're not in bankruptcy, then you're going to enter that data, key it as you see it, and that's a fully taxable event. And this upsets people, to be quite frank with you, and they don't understand the concept. This is how I explain it. I explain to them, you had a credit card, which means you had an economic benefit. You bought some stuff and you didn't pay it. And so Congress says, since you had an economic benefit, that's going to be a taxable event. And then they're still not happy, but they say, okay, yeah, I got it. And then you include it as income. All right, and then let's go to our itemized deductions. And if you remember correctly, We only had, this is a standard deduction couple, but we did have gifts to charity. These individuals donated cash. And in this case, it's a qualified charitable organization. And I mentioned before, and we had an example at one of our sites, and it was kind of sad, but a lady had, she had a wonderful heart. She donated $8,000 to an organization, and she had modest income. And we looked up that organization, and we told her, this is not a qualified charitable organization, so you can't take a tax deduction. And she was very unhappy about that. She says, okay, I understand that, so I'll find a charity that's qualified. So it has to be qualified. And we mentioned that last week. You can drill down on the IRS website to find a qualified charity. Down here, there's $300. That will be carried forward to page 1 of the Form 1040.
Jerry?
Yes.
This is Catherine. Through your whole scenario, I noticed that both she and her husband work, but there is no child care expense.
That's right. That was intentional. It could be a situation where grandmother watches the children, but typically when you have minor children, you're going to have a care provider, or you might have a relative that watches the kid. Okay, for demonstration purposes only, what I did is the tax and unreported tip income. So if you have someone who's not reporting their tips to their employer, then what they have to do is you've got to go to that W-2, you got to plug in that amount, and then you'll open up a 4137, and then the 417, you're going to populate that. And then what will happen is a 4137 will be generated, and it'll share, let me restate that, it will show the amount of Social Security tax and Medicare tax, which is 7.65% on the total amount. So the way I tell people, if you don't report your tips to your employer, you have two obligations. One, you have to pay income tax on your tips, and two, you have to pay FICA on your tips. And then most people, they go, oh yeah, I got it. Now, this is not part of our scenario, so I'm going to make it go away. And you can see the garbage can there. The red garbage can makes it go away. And then for demonstration purposes, we talked about that first-time home buyer's credit. And I was working with this the other day. This is the screen in the software, and it asks for information regarding your residence. And keep in mind, if you do fill one of these out, you'll fill it out, and it says right here, half for the husband. And let me restate that. You'll fill this document out, and you can see right here for joint filers, you've got to enter both information. So you don't see it very often, but this is the screen. Again, it's called the 5405. Not part of the scenario. We're going to make it go away. I hit cancel, hit the garbage can, and it goes away. Let's go to our covered California after we hit the estimated tax payments. Here, the estimated tax payments per the scenario, we had our taxpayer who made 3. And I will tell you from personal experience, I was filling out my return a couple of years ago, and I forgot, I made some estimated tax payments. I had to actually reach out to the IRS and say, hey, how much did I pay you guys? And you can find that, or sometimes people have canceled checks. But in this case, she made 3 payments, which are reflected here.
Hey Jerry, can you show me how you got to that page right now that you're showing the payments and estimates?
Sure. When you go to payments and estimates, you have one for federal and one for state, and then you open that up. That help you out?
Absolutely. Thank you so much.
Okay, great. And let's go to our health insurance. And just a reminder, we mentioned this before in one of our previous PowerPoint presentations. The state of California, they do have a individual share responsibility payment, which means for tax year 2020, if you don't have health insurance and you're a California resident and you don't meet one of those exceptions, you're going to pay a penalty to the state of California. The federal one doesn't have one, that's gone away, but the state, they do have one. So just keep that in mind when you look at the real software. Okay, if you go to your scenario, for our taxpayers, you can see where our taxpayers, I got to go to the right page here. I think it's page 4. You can see where they're in covered California. And so what I did is I entered data for the family, and this is my family. They're covered, paying those health insurance premiums to covered California. And then I opened up this page right here that says the advanced premium tax credit. And what I did is the first question said, are you required to repay? Generally, it's going to be no. And then the second question talks about that 1095 A as in alpha, that's the marketplace statement, and they're going to receive that document from the Covered California program. And I don't know if that's provided in a hard copy format or an electronic format, but nonetheless, they're going to get it. And so you would check that. In this example, column A, B, and C are all the same. So this is one of those easy breezy ones. And you're going to key the information. You can see right here on the screen, this is going to be line 33 alpha. This is the amount on 33 Bravo and the amount on 33 Charlie. If they're not all the same, when you hit no, then you're going to plug in the amounts for each particular amount. But again, key it as you see it. And if someone comes to your site and they don't have this form, tell them I'll be happy to help you, but you got to bring this document to the site. Or in the virtual world, provide it in some type of virtual means. We hit continue. And I don't try to embarrass people, but what I try to do is I try to be as factual as I can. And Covered California, it simply means the individual is purchasing insurance or paying premiums, but they are subsidized by the taxpayer. And what happens is if that subsidy is too little, they're going to receive the premium tax credit. If the subsidy is too much, they're going to pay it back. This screen right here, generally you're not going to enter any data. So we'll go past that. And we don't have the state return loaded up, so we're going to go past that. Now, I think I've addressed everything on the return. Mel, can you come off mute and can you tell me if you can see the Form 1040?
Yes, I can.
Okay, good. I'm going to stick with this one because the other one I had problems displaying the other day. So here's our 1040. You can see the amount of the wages on line 1, interest and dividend income, and then you can see the amount of the distribution, which is a fully taxable event. And we did talk about the simplified method. That's when someone has basis or cost in a retirement plan. That's not the case here. Total income is reported. Other income, that's going to be from that Schedule C. And then you see the total income. And then you also see adjustments to income. And that's going to be that 1/2 self-employment tax. Let's go down to the standard deduction. You can see the standard deduction. Now on this form, and I do recognize it, it does say 2019, so it doesn't show that $300 amount. I'm going to see if I can bring up the 2020. And you're thinking, Jerry, you've entered data in the 2020 tax lab. Why doesn't it appear on the screen? Well, the answer is obviously there's a disconnect with the contractor. It's a work in progress, if you will. The qualified business income deduction, 20%.
Excuse me, Jerry, can I throw in, if you go to the e-file page and click on the paper return, it will bring up the 2020 and it will show that $300 deduction.
You are absolutely correct, and I've had issue after issue after issue displaying it in a Zoom call, but we will try that once we go through this. Okay, and so you can see that. And then let's go to the page 2. You can see the amount of tax and then the various credits and of course the additional tax. And then you can see the EITC, and I'm going to post this. I will send these school solutions to Fred and Mel, and they can share it with the world, i.e. the school solution. So you can see the various credits, and then you can see the amount of the refund. Now what we're going to do, I'm going to go to my e-file. I'm going to see if I can display the return. Yeah, I tried to do this a couple days with the tax class I was teaching, and I was unsuccessful many times. So let's try it one more time and see if we can display that. So what the previous individual said, you go to return, paper return, you save that, And then you go to the blue tab that says print the return. And then we're going to attempt to open it up. On my screen, the 2020 will be displayed. Mel, let me know if you can see the 2020 in just a moment. Can you see 2020 on your screen?
No.
No, nothing.
That's what I thought.
Well,
Okay, so
it'll be
once
a new instance, so you have to change your screen share to access it.
okay, I will try it one time and then that is it.
Fair enough.
Because I have had mucho issues with that. Okay, now can you see it?
Yes.
Yes. Yes.
Ah. What's that term? Praise be to Jesus. Okay, great. All right, so we got our 2020. And as the previous individual said, you can see now where that charitable contribution is going to be populated on 10B. We see our income items over here. And then you can see that qualified business income deduction is 20% of the net income. Taxable income, if you can see that, I'll try to make it a little bit bigger, 21,835. Let's run through the rest of this return. Again, I will send it to Mel so everybody can take a look at it if they want.
Thank
you. You can see the amount of the total tax is 773. We got withholding of 4,000, and you can see the various refundable credits, which include EITC, additional child tax credit. Refund is 7942. And then we're going to go to our next page, which is going to be our additional income. And we see our business income reflected at 3,700. Our discharge of debt, 950. Adjustments income is 1/2 self-employment tax. Our additional taxes will be that self-employment tax for the Schedule C as in Charlie, and then the 10% of the additional tax from that IRA distribution. And then we've got our net premium tax credit, and that's calculated. What that means is when people say, Jerry, what's that? I tell them that is the amount of the subsidy that you're going to receive, the additional amount, because you received insufficient subsidies according to the Affordable Care Act. And that's that. And then, of course, yeah, I think that's enough there. Let's see here. Let's go to our next page. Itemized deductions. People say, I thought I got the standard. And I say, yes, you did. However, this is displayed. And let's see. Here we go. We entered that 300. That carries forward to page 1. But again, they receive the standard deduction. Sometimes your practitioners will take this page out if they take the standard deduction. For my private clients, I always take this page out if they have a standard deduction. It confuses people. Interest and dividend, and I will mention this. If you go to the bottom of the document, if you have someone who has a tax, I stand corrected, if you have someone who has a bank account in a foreign country, you need to identify that. And a foreign country is Canada or Mexico. Here's your Schedule C as in Charlie. A lot of times when I show the Schedule C to a VITA taxpayer, they'll say, hey, wait a second, I did have some advertising. I did have this. We go back and we change the screen, and then we show it again, and then we print the return. Self-employment tax for people who are brand new as a self-employed individual, it's really good to go through that portion to explain, yes, they have to pay this based on net profit of $400 or more. Okay, and this is your form. You're probably familiar with this. I've used this a couple times when I cashed out some monies years ago, and my wife used this years ago. But again, that's at 10% penalty if you're subject to that 10% penalty. And then let's see, what else? Earned income credit. I don't usually spend a lot of time. I may show this document, say, you're entitled to the earned income tax credit. This is what it is. If you choose to go through it, yes, you'll spend a lot of time with this. I guess it's up to you. I typically don't have my volunteers spend more than about 10 minutes going through the return with the taxpayer because we've got other taxpayers waiting. This is the additional child tax credit. Again, the maximum per child for the child tax credit is $2,000, which includes the refundable portion, which is up to $1,400. And this is your QBI. I simply tell people if you qualify, you get 20%. That's reflected on page 1 of the return, 20% of your net income. Premium tax credit, again, I tell people you had an insufficient subsidy in this year, and because you had an insufficient subsidy, you're allowed this refundable credit. If your subsidy was too much, then you got to pay it back, and that becomes a painful discussion. Okay, I think that's it. Mel, let's see. I think what we'll do here again, just as a reminder to everybody, I'm going to go ahead tomorrow. I'm going to post those solutions to the previously sent tax returns. And then next week, we'll be able to run through any questions that people have. But what I'll do is I'll just open it up. Does anybody have any parting comments?
Okay, anybody, you can unmute yourself and you can talk.
I'll make one comment. This is Scott. Relative to resident aliens, early on in the first hour, you're talking about that. If anybody has any questions as to what constitutes a resident alien for tax purposes, check tab L in 4012.
Thanks, Scott.
Okay, good point. Good point. And yeah, you will see that. You will see people who live and work in the United States, and yet they're a Mexican national or a national from Nicaragua or Guatemala. And since they're living and working in the United States and they meet the substantial presence test, they file a Form 1040 just like you and me, even though they have an I-10.
Yeah, but be a resident alien has an entirely different definition between immigration status and tax status.
So you're absolutely correct. Like I say, you have a resident alien, the person has they've received the documents from the United States government, and then you have a resident alien for tax purposes because they meet the substantial presence test. That's correct. Okay, anything else? All right, ladies and gentlemen, thank you for joining me. Thank you for participating. I'll see you next Saturday at 9 o'clock, and the focus will be on the California tax return. We'll talk about non-refundable credits, refundable credits for California. We'll talk about the CA, the Form CA, and we'll give you an appreciation for the Form 540, and then we'll do our wrap up. All
Gary,
right.
thank you.
Okay, thanks
Enjoy the
everybody.
game.
Thanks for all the
Enjoy the game.
comments and participation. See you all later.
Thank you.
Bye-bye.
Thanks,
Bye.
Jerry.
All right.